call this meeting to order. This is meeting number 72 of the Standing Committee on Finance. Orders of the day pursuant to Standing Order 1082, continuing our study of the impact of low oil prices on the Canadian economy. Colleagues, we have two panels here this morning. In the first panel, we have 5 presenters. We have, first of all, from the Bank of Canada, we have the Deputy Chief, Mr. Rhys Mendez. Welcome to the committee. From the Canadian Automobile Association, we have the Vice President, Mr. Jeff Walker. Welcome. From the Canadian Manufacturers and Exporters, we have the President and CEO, Mr. Jason Myers. Welcome back. From the Canadian Vehicle Manufacturers Association, we have the President, Mr. Mark Nante. Welcome to you as well, Mark. We're just having a little trouble with our video conference. We'll have from Toronto, we'll have economist Jim Stanford from Unifor, so we're hoping to get that up here in the next minute or so. You will each have 5 minutes maximum for an opening statement, and we'll begin with Mr. Mendez, please.
Thank you. Good morning, Mr. Chairman and honourable members. On behalf of the Bank of Canada, I'd like to thank you for this opportunity to share our analysis on the impact of lower oil prices, both on the Canadian economy in general and on the manufacturing sector in particular. I should mention that our analysis is at the level of the economy as a whole. The rapid fall in oil prices is going to have both positive and negative effects on different sectors of the Canadian economy. And to discuss the overall impact and to assess the overall impact, we used a modeling tool that we built to take account of the various channels and spillovers across sectors. We also drew on numerous surveys, meetings with firms and business associations. The bottom line is that the sizable decline in oil prices since June 2014 is unambiguously negative for the Canadian economy. As outlined in our January monetary policy report, most of the negative effects will appear in the first half of this year. The energy price decline will reduce aggregate income. Indeed, even though real GDP grew in the fourth quarter of 2014 by 2.4%, the real incomes of Canadians contracted. This occurred because the world price of an important Canadian export declined, and that means a loss of purchasing power for Canadians. In addition to this negative terms of trade effect, business investment is expected to be weaker. So business investment in the oil and gas sector, which is roughly a third of total business investment, is anticipated to fall by about 30% in 2015. But the effects of the oil price shock will be felt across the country. The main transmission channels are, 1, the aggregate income effect, which works through lost purchasing power, and 2, supply chain effects, which work through interprovincial trade. For example, nearly a third of the goods and services purchased by Alberta's oil sands industry are drawn from other provinces. There are some positive but partial offsets. While Canadians are worse off in the aggregate, cheaper oil means more money in the pockets of individual consumers. They can either spend the additional disposable income or save it, and these decisions will matter for economic growth. In addition, lower costs for firms that use oil as an input may lead to a rise in profits, output, and investment in non-oil-related sectors of the economy. It's also important to keep in mind that today's lower oil prices are mainly the result of abundant global supply, as my colleague Deputy Governor Tim Lane pointed out in a recent speech. This supply-driven decline in oil prices is stimulating economic activity in the United States, our main trading partner, and this will support Canadian exports if the export sector responds in line with historical experience. Lower oil prices will have an impact on Canada through another channel. Because we're net oil exporters, the value of the Canadian dollar tends to move with the price of oil. So from 2002 to 2008, oil prices and the dollar were both on a general upward trend. You may recall that in 2008, when oil was trading at well over $100 per barrel, the Canadian dollar was almost at parity with the US dollar. Today, we're much lower, and our dollar is at about 80 cents against the US dollar. The lower dollar is improving the competitiveness of production in Canada, which should further boost exports and eventually investment. Altogether, as we noted in our January monetary policy report, the manufacturing sector is expected to benefit from stronger U.S. demand, lower shipping costs, and the weaker Canadian dollar. As we assess the ability of Canada's manufacturing sector to benefit from cheaper oil and the lower dollar, we have to recall where we're coming from. In Canada, competitiveness challenges and a prolonged period of weak U.S. demand forced many of our non-energy exporters to discard unneeded capital and eliminate jobs, or to close their doors for good. So rebuilding the lost productive capacity won't happen overnight. The bank has long been saying that in order for us to return to sustainable growth, we need a rotation of demand toward exports and business investment. Growth in our non-energy exports is showing more momentum in recent quarters, suggesting that that rotation is indeed happening. Finally, let me note that our most recent Business Outlook survey indicated that hiring intentions and investment plans were robust for manufacturers. A majority of firms reported that they were planning investment projects aimed at increasing production. Overall, these are positive signs that the rebuilding process is underway. So this concludes my opening remarks, and I look forward to the discussion. Thank you.
Thank you for your presentation. We'll go to Mr. Walker, please. They'll operate that for you. Don't worry.
Oh, all right. Thanks. Thanks for having me. Very much appreciate it. At the Canadian Automobile Association, we're a representative organization of 6.1 million Canadians. And we're very active in the consumer space. We're very keen to kind of stay apprised of key issues affecting Canadian consumers that sort of cover the waterfront of the areas we're in, specifically around vehicles and things like gas prices. And actually, we've been commissioning consumer research on the changes in gas prices over the last few months. Our most recent research just came out in January, and it's quite fascinating, actually, what we're observing. I guess the first thing is to say is people are paying attention. People really are paying attention both to the drop in gas prices and to the larger changes that are happening in terms of oil prices overall. But the world they see is, I got cheaper gas. The world they're thinking about is not so much about oil prices. And so from the consumer point of view, for the most part, Canadians are seeing it through that lens, at least today. So they're watching it. Even they're doing some things that are counterintuitive economically. What we found is people are paying more attention. They're actually driving further to get cheap gas, as gas is cheaper than it was before. So some of the stuff doesn't even always make economic sense behaviorally, what's going on. But people are happy at that level. Well, that's what we've observed. In terms of how people see the larger impact, really what we observe is that there's Alberta and there's everybody else. That Albertans in the data say, we're really worried about the macroeconomic part of this equation. And the numbers, is this going to have a significant long-term economic impact? Albertans are disproportionate. Two-thirds say significant effect. Everybody else, minority actually, sort of in the 1/3 to 40% saying significant negative macroeconomic effect over the longer term. And the reason why, from what we see in the data, is that most Canadians still believe this is a short-term thing. They don't think that this is going to go on a long time. So we asked the question of how long until gas prices go forward? Will they go up again over time, or will they stay down? And people are still saying this is a 3 to 6 month thing. They're expecting it to turn around and maybe not quite go where they were before, but not to stay down in the ballpark that it's been. So because I think in part they don't see it as a long-term thing, and I think people in this panel would say it could be, there's a gap in terms of their perception of where it's going to be macroeconomically over time. So we would perceive that as this goes on, there'll be more Canadians that will be thinking more like Albertans already are about where this is. A couple of final points let me make about this is that what we observe now is that they are feeling pretty good economically overall, as Jason alluded to. They're not seeing, other than Alberta, prices changing in housing or job losses. You made the reference of job intentions in Ontario and other manufacturing parts of the country. People aren't seeing that. When they're not seeing that, they're not going to start saying we're concerned. And so what we see is a little bit of, it's microeconomic for today for everybody outside of Alberta. In Alberta, it's a macroeconomic problem. And we'll see where that goes over time as people understand and recognize this could be a longer term versus a shorter term problem.
Your presentation, we'll go to Mr. Myers, please.
Okay, merci, Monsieur le Président. I have
Thank you, Mr. Speaker.
a document analyzing from our perspective the impact of lower oil prices on the manufacturing sector, and I'm not going to go into detail there. You can take a look at that yourself. I want to say that the only thing I could probably accurately forecast is that if you have a group of economists, you'll at least get as many, if not more, opinions about what the impact of lower oil prices are on the economy. But let me focus on a couple of key issues. One is the relationship between the American dollar and the price of oil. it's important to realize that oil prices are denominated in U.S. dollars. And if the currency exchange rate of the U.S. dollar is rising against other currencies, the price of oil will naturally fall, and you don't need any change in supply and demand to affect that decline in the price of oil. Very strong correlation. In fact, if you take the U.S. dollar against a basket of currencies, weight it in terms of overall transactions for oil, what you find is that the U.S. dollar has fallen by 25%, and that accounts for just over half of the decline in the price of oil that we've seen since last September. So this is a story about the strength of the U.S. dollar right now, which is an indication that other economies appear weak or are weakening, which is also feeding into the other 50% of the equation about supply and demand in oil. Lower global demand for oil, continued overcapacity there on the supply and demand side, so that's also bringing oil prices down. That's important because the impact on Canadian manufacturing of the lower prices of oil, I agree with Reese, is negative, net negative. That is, though, being offset and will be offset over a period of time by a stronger U.S. economy, also by the fact that the Canadian dollar is relatively low against the U.S. dollar. Reese mentioned the impact that lower oil prices was having on economic activity in Western Canada. That, of course, affects manufacturing across the country. About $12 billion a year, we estimate, will be the hit on the manufacturing sector. It's not only because of lower demand for manufactured products and equipment, particularly in the new projects in oil and gas, or in the oil sector in Western Canada. It's also because right now there's tremendous downward pricing pressure being exerted by the procurement companies, by the major oil operators throughout the supply chain. So it's a matter of not only lost production, but also very, very dramatically lower pricing leverage. On the part that is offsetting the impact of oil prices, of course, is the fact that to some extent, some sectors will be benefiting primarily from lower feedstock costs. So the petroleum product sector, for instance, petrochemicals, plastics, the price of those materials is coming down along with the price of oil, not as rapidly. But that is having some positive cost implications for manufacturers that use those feedstocks. On the whole, though, let's not exaggerate the impact of lower oil prices on energy costs. Energy costs from oil are 0.3% of total operating costs for manufacturing. The impact is marginal here. The biggest benefit will be on the purchasing power, not of Canadian consumers, because you go down south, you're going to be spending a lot of that money down south, or on imported products. The biggest benefit is to strengthen the consumer recovery in the United States. And so a combination of lower dollar, stronger U.S. recovery, that's where the major benefit is. One final point, though, is that we can't take the lower oil price, the stronger U.S. economy, lower dollar for granted. That's not a silver bullet. Nobody's going to be competitive unless they continue to invest in new technology, new products, better skills. Competition is intense, and the currency rates across the world, or around the world, are also falling here. So this is no silver bullet for Canadian manufacturers.
Thank you very much for your presentation. We'll go to Mr. Nante, please.
Thank you very much, Mr. Chairman, and good morning. From the CVMA's perspective, we expect lower oil prices will have actually a mixed effect on the auto sector in terms of consumer purchases and for manufacturing operations. And if there are 4 points I'd like to leave you with today, they'd be as follows. Automobile manufacturing looks at the long term for investment decision-making and establishing business contracts with suppliers and transportation services. Secondly, the price of oil potentially impacts auto companies in 2 ways, both in terms of vehicle sales and in terms of production. Thirdly, the impacts of lower price oil are varied and they are not immediate. and the vehicle market response and demand for certain vehicles can adversely impact production depending on the type of vehicles being produced at our plants. And fourth, the suggestion that competitiveness is enhanced by a lower Canadian dollar can be misleading and may not be a factor in changing a company's outlook on competitiveness. Prior to the decline in oil prices, Canada experienced two back-to-back record years for new vehicle sales, and forecasts for 2015 suggest another record year with new vehicle sales growing at between 2 and 4%. But since the decline in oil prices, new vehicle sales in Canada continue to increase on an overall basis at a rate of about 2 to 3% over last year. We are starting to see signs of regional differences in the rate of sales, however. For example, new vehicle sales in Alberta declined in January 2015 versus last year, with overall sales in Canada continuing to increase. Thus far, the impact of lower oil prices has strengthened truck and crossover sales on a North American basis, but there is a related softening in car demand in certain segments. As such, we submit that lower oil prices and lower Canadian dollar will still result in softening of some car-related production in Canada. As mentioned, investment decisions are made on a long-term basis, and while the lower Canadian dollar and lower energy prices should help some input costs, the relative cost of manufacturing in Canada will have to continue to be measured against the relative cost of manufacturing in other countries that will also benefit from lower energy prices and lower currency values. In theory, auto manufacturing plants should benefit from the recent drop in oil prices in the short term, respecting both operations and transportation costs. This is subject to any drop in oil prices being passed on to the manufacturer or customer in the form of lower energy prices. This cost reduction is not immediate, nor is it absolute. When considering the longer-term competitiveness and factors that weigh into investment decisions, the changes in oil prices and resulting fluctuations in currency represent short-term impacts and are likely not the most critical factors in manufacturing investment decisions, nor does it guarantee improved competitiveness. In terms of auto manufacturing, the lower cost of oil highlights the increased importance of non-energy-related exports and investment to support the Canadian economy, and hence an even greater importance to have the right mix of policies in place to support a competitive auto manufacturing industry and manufacturing more generally speaking. Annual Canadian automotive exports are about $64 billion. About 85% of the vehicles we build in Canada are exported to the United States. It is anticipated that the added savings due to low oil prices will add to the available personal disposal incomes in the United States, and this will be positive for the U.S. economy and the demand for products we export there. We cannot look at these issues in isolation, and while we have seen recent investment announcements, it is imperative that we continue to assess all the factors that affect investment decisions in the longer term. It remains critical for Canada to have a globally competitive investment support strategies in place to secure reinvestment of the existing automotive footprint. And to keep pace with changes in competitive jurisdictions for auto investment, the government is encouraged to review, for example, the Automotive Investment Fund in the context of incentives being promoted in competing jurisdictions that are actually successfully winning some of these new investments. It should also look at the ability for large companies to exchange unused SR and ED tax credits in exchange for direct funding when used for new R&D projects. These would both be improvements. In closing, Mr. Chairman, the committee's study of the impact of the price of oil on the economy is really a worthwhile exercise. The message I would like to impart to you today is that in a highly competitive environment for global automotive investment decisions, there are factors more in the control of government than the price of oil that would have a greater positive impact. Mr. Chairman, thank you very much. I'll be pleased to answer any questions you may have.
Thank you. Thank you very much for your presentation. Colleagues, we are still trying to get the video conference set up with Toronto. We haven't been successful to date. We'll keep trying to do that. Let's do 6-minute rounds, starting with Mr. Cullen.
Thank
please.
you. Mr. Nante, can you just repeat that last sentence that you had in your testimony if you have it handy?
The message I'd like to impart with you today is that in a highly competitive environment for global automotive investment decisions, there are factors more in the control of government than the price of oil that would have greater positive impact.
There are factors more in the control of government?
Correct.
Can you just illuminate a little bit, one or two specific ones that you would... Basically, thank you, first of all, for your presentations. I find this very engaging. What we're looking at here is to understand what the impacts are, as many of you have outlined, and also what, if anything, government should be doing about it. We have a budget coming sometime this spring. We're looking at policy options, and we, of course, are in an election year as well, as people are considering what to do about the current situation, given what it is. One or two things, Mr. Nante, that you would point to?
Sure. First off, I did mention the Automotive Investment Fund.
Yeah.
Clearly making that fund competitive with other competing jurisdictions, benchmarking against
Are we
those jurisdictions.
are we competitive with Mexico right now in terms of support for the industry?
Well, you have to look at this in the context of, what is appropriate for Canada versus Mexico, what we can afford, what we can build upon in terms of our competitiveness here, and the combination of other policies which will contribute to our
So the straight-up subsidies that Mexico is doing quite well. We're experiencing our lowest market share since 1987 in the North American market as automakers. That's been in a pretty steady decline over the last number of years. Since the recession in particular, we've seen a large investment heading south of the other border, and less so here. But we can't subsidize the way the Mexicans do.
No, but we have other things we can build upon, and there's other things we can do. And the recent, we had 3 major investments recently.
Yeah.
That's in the context of the current environment, competitive environment. So we can do more. Standards harmonization is another area where it provides real benefits to our industry on a North American basis. These are things we're already doing.
These are concerning trends. Just the few that I mentioned, and the $19 billion trade deficit we're running right now just on auto and auto parts. A question going to Mr. Mendez is the bank concerned with the debt load that consumers are currently bearing in Canada right now, the personal debt?
Yes, we've outlined on a number of occasions that the high levels of debt, household debt, do create a vulnerability in the Canadian economy. I think one important thing to note is that with respect to the decline in oil prices, our analysis suggested that the decline in oil prices from $110 in the middle of last year to $60, at the time we did our January monetary policy report, would have reduced incomes in such a way in the absence of any policy response that it would have actually raised the debt-to-income ratio, which is what we would think is the key for assessing that vulnerability. And so the policy action that the bank took in January was aimed at in part, at mitigating
that debt-to-income ratio.
Impact, that adverse impact on the debt-to-income.
So the bank took action out of concern for not just the personal debt that Canadians are holding, but was it I don't want to put words in your mouth, is it a stimulus initiative? Was it an effort to, in a sense, kickstart the economy?
Well, I mean, as I said, the oil shock was unambiguously negative for Canada overall. And so, we assessed that in the absence of any policy response, Canadian output would have been about 1.4% lower by the end of 2016. And the output gap, that is the difference between actual economic activity and the sort of potential full capacity level of economic activity, wouldn't have closed until sometime into 2017. And so we were basically taking out insurance to give us greater confidence that we would return to a full capacity economy by the end of 2016.
You haven't used the word, but it sort of sounds like an attempt to kickstart, an attempt to stimulate. But is that a loaded economic phrase? I don't want to, again.
No,
I'm trying to interpret the bank's initiative to do, because it surprised everybody, as you know. But the bank took a longer view on this and felt that this was important to do.
I think it's clear that monetary policy in Canada has been stimulative for some time in response to the after effects of the global economic and financial crisis. And the monetary policy responds to all the shocks that hit the Canadian economy in order to try to return inflation to target over the medium term.
Thank you.
Okay.
I want to be careful. Mr. Walker, I wanted to challenge one thing that I think it was you that talked about the consumer confidence perhaps being concentrated in Alberta where the worries are greatest. Was it you that spoke to this?
All I said is that in Alberta what we see, what the data tells us is that the concern around the macroeconomic aspect of this has taken hold to a greater extent than it has in the rest of Canada.
Yeah, the only reason I bring it up is I was just looking at the Conference Board's report that showed consumer confidence fell 11 points, but across BC, Alberta, Ontario, and the Atlantic provinces. I'd sort of want to debate that, but without the time to do it. Last question to Mr. Myers. Do we know from the manufacturer side of thing how much of manufacturing in Canada is tied to the energy sector? Does your association able to present, because we're talking about whether there's going to be a pickup in the manufacturing industry, as has maybe been historically true, and there's some uncertainty as to whether that's in fact true.
Right.
Just a brief response, please.
Yeah, the analysis we've done is for oil sands, and I'll send a copy of our analysis to the committee. It basically shows that there could be a $12 billion hit on overall manufacturing sales across the country.
Okay, thank you. Thank you, Mr. Cullen. We'll go to Mr. Saxton, please.
Thank you, Chair, and thanks to our witnesses for being here today. My first question is for Mr. Mendez at the Bank of Canada. Some people have characterized this as an economic crisis. Do you think this is an economic crisis?
Well, I mean, as we've said, it is negative for the Canadian economy. Canada's economy has over time demonstrated the ability to flexibly respond to various shocks. Through the period of rising oil prices, labor and capital shifted across sectors and across regions in response to the incentives created by that, and some of the same trends will likely reverse in response to lower oil prices. Overall, it is as I said, it is negative for the Canadian economy.
Does the bank take into consideration that many of the jobs lost in the energy sector were in fact contract positions that will be reestablished once the price goes back up?
Well, so our working assumption in our analysis is that the price remains constant at roughly its recent level. So in our latest monetary policy report, that was for Brent oil prices, that was $60. And that assumption is driven by the fact that number one, it's consistent with our assumption for the Canadian dollar, which we assume to be constant over our projections. And number two, it's difficult to beat a constant oil price assumption. It's difficult to forecast oil prices. We did in the past use futures prices, but they didn't do materially better. So for simplicity, we assume a constant oil price over our projections. So,
Sorry, Mr. Mendez. Is there something on that's causing a beep at our end? Laptop or anything?
I think they're trying to fix this, so I think it's the lady behind you, Mr. Chair.
The back room, it's not her.
The back.
I think we can live with it, Chair.
Okay, sorry, I apologize for that.
Condition
It's,
normal.
just, it's Mr. Cullen thinking out loud, that's all.
Okay, I apologize, Mr. Mendez. Well, please continue.
Have we restarted the clock there, Chair?
Yes.
Okay. Thank you. My next question is for Mr. Walker, CA. How have the lower oil prices impacted your members?
So far, most members are pretty happy about it. I mean, this is the thing, though. Again, most consumers on their day-to-day level are thinking about relatively short-term, relatively microeconomic considerations. And because you fill up gas once a week, it tends to be a sort of a reference point for how you're feeling overall. So in general, as I sort of alluded to earlier, is that most Canadians so far are feeling pretty good about the fact that they've saved ballpark 30% on gas than they had been previously, and it was almost like they had no idea it was coming, so it was like a nice bonus for them. As I said, more in the West, in Alberta, and to a lesser extent Saskatchewan, you see more people reflecting a sense of, whoa, this could be a bigger picture, longer-term macroeconomic problem. And so the short-term, hey, I'm getting cheaper gas, is trumped by, wow, my house price might drop by 30% or 20% or some significant number. So it depends on where you live, how it weighs out in terms of people's overall feeling about what's happening in gas prices. Can I make one additional point that I think is really important here, though? Over time, what we've seen, you said, the oil price has gone from 110 to roughly 60, right? Gas prices have not dropped by that same amount. Right. There's studies that have been done in the past. They call it the rocket and feather effect in gas prices, where they rocket up when oil prices go up, but they don't come down that fast when oil prices go down. One of the things that I believe this group might want to look at are some studies around what is happening in terms of the impact on the relationship between oil prices and gas prices at the pump for consumers over time. Because if you look at those proportionate changes, it isn't the same.
Thank you very much. My next question is for Jason Myers. Jason, have you seen that in central Canada manufacturers have actually benefited as a result of the lower oil price?
Not so much from the downward trend in oil prices, but from the stronger growth in the U.S. and from a lower dollar. I think one of the key things, and it goes back to your previous question about employees in the oil sector, a number of manufacturers across the country, particularly in Ontario, Eastern Canada, and in Quebec, see, I think, opportunities to take some of the people who were previously employed in the oil industry and who are traveling across the country. It's going to ease their ability to find skilled workers, and particularly in the trades, and that may have a positive impact on their ability to increase production and relieve some of the capacity constraints. So I think that's one of the positive impacts here.
Greater labor supply as a result?
Yeah.
Isn't that interesting?
Yeah.
Okay, thank you. And thank you, Chair. And finally, Mr. Nantes, how has our government support for the automotive sector helped CVMA members?
Well, it's helped tremendously, not just CVMA members, but all vehicle manufacturers who actually produce here. So, we have, as I mentioned, supports in the form of the Automotive Investment Fund. We've got a very significant effort in the issue of standards harmonization on a North American basis. We've got other measures in terms of SR and ED tax credits. Yes, we can make some changes to those, but these are all things that have been very helpful and will continue to contribute to new future investment considerations. And the question is, though, we need to benchmark, we need to be competitive with these other jurisdictions who are upping their game. And so that will be the challenge as we go forward. But there's many policies in place right now that are very helpful, not just to the auto industry, mind you, but manufacturing generally, including accelerated capital costs.
Mr. Saxon, we'll go to Mr. Bryson, please.
Chair, and thank you to each of you for joining us today. Mr. Mendez, do you agree with private sector economists, Doug Porter and others, that oil prices is a precipitous drop, but for the midterm that there's a stabilization, and that we're in kind of a slow growth environment with lower commodity prices for at least the midterm?
So as I mentioned, we don't actually produce a forecast of oil prices. We make an assumption that they stay near their recent levels. We do, of course, analyze the risks around that assumption. And, there are both upside and downside risks to the $60 assumption we made for Brent oil prices. On the upside, it's, if you think about the cost of producing oil, a substantial proportion of world oil production today is too costly to be profitable at a $60 price. And so you can imagine that supply would over time disappear, and that could put further upward pressure on prices. On the downside, there could be further innovations in technology or cost-cutting measures that could put further downward pressure on prices. Overall, we see the risks to that $60 assumption that we made as tilted to the upside over the medium term.
But you're able to make your forecasts and projections despite the volatility, or you're able to build in those assumptions and potential outcomes into your forecast?
Well, as I said, we make an assumption. There's a lot of uncertainty around that, of course.
Certainly. The Bank of Canada said that its fall in oil prices is unambiguously negative for growth in Canada. Is it fair to say that it's unambiguously or overall it's positive for growth in the U.S.?
Yeah, so our assessment is that the decline in oil prices from the middle of last year would raise U.S. GDP by the end of 2016 by about 1 percentage point.
So negative for Canadian growth, but overall positive for U.S. growth. Will that put pressure on the Fed to potentially raise rates in the U.S.?
Well, I can't comment on Fed policy. I mean, the positive for U.S. growth, though, is a positive for Canada.
Well, what would be the implications on higher rates in the U.S.? What would be the implications on the Canadian economy?
Well, I think we've said that when higher rates do come about in the U.S., they're likely to be associated with a stronger U.S. economy, and it's the stronger U.S. economy that would really be.
Would it increase pressure on the Bank of Canada to follow through with potentially higher rates if the U.S. were to do that, or would that
Not necessarily. I mean, the bank targets inflation in Canada, and the decisions regarding monetary policy in Canada would be based on the outlook for inflation.
And would higher rates in the U.S., but changes in the U.S. economy in terms of growth could affect inflationary pressures in Canada as well?
Certain.
Thank you. The impact of falling oil prices on, you're saying, the Canadian auto dealers, and you're saying, I think that I've got cheaper gas, and that's going to have an impact. Is it impacting? Are people driving bigger cars? We've heard this, or potentially buying bigger cars. Is it affecting people's purchase decisions in terms of the kinds of vehicles they're buying?
Mark could probably speak to this more than me, but what we see is the same thing that some others have alluded to. These are more long-term kinds of changes. I mean, people buy a car once every 3-4 years. They won't change their behavior in the short term as quickly, unless, of course, you have a lease and you might want to switch over. The data it will be too fresh to make any comment on that, to know.
But it's having an impact on people's confidence in terms of consumer acquisitions and purchases. That's what you're
maybe in some
earlier.
some parts of the country where they see the macroeconomic forces being more significant and more long term, as in Alberta. I'm not sure that's true anywhere else.
Mr. Mendez, what's the impact on the Canadian employment market of softer oil prices? What do you see as the impact? Is it a softening of the employment market in Canada?
Well, again, so as I said, we had forecasted that in the absence of any monetary policy response and any other shocks, that the decline would have lowered output and economic activity in Canada.
So
of course, there would
employment.
have been an impact on employment also.
You see slow growth as a secular trend in Canada in terms of a slow growth economy for the foreseeable future?
We see trend underlying real growth in Canada as just below 2%. And that is somewhat slower than say before the global economic and financial crisis in the mid-2000s. But a lot of that is just the fact that we have slower labor force growth due to an aging population.
Mr. Myers, you've said that there's some positive impacts and some negative impacts as a result of lower oil prices. The positive impacts, what is the timing of what do you see for the positive impacts, and what is the delta between the timing for the positive impacts and the timing for the negative impacts?
Just a brief response, please.
I wish I could forecast like that, but I think we're already seeing the positive impacts in terms of stronger consumer buying power in the United States. That's as well as to some extent correlated with this a stronger U.S. dollar, weaker Canadian dollar. So those are impacts that are being felt right now, and they're very positive. The question is, where is that going? And I would say one thing, that when you see a plunge in the price of oil or any commodity like we've seen over the last 6 months, this is not a good signal, particularly when that is being triggered by such a rapid appreciation of the U.S. dollar and such a plunge in other currencies. It's a signal, if not in the oil market, it's a signal that we have really very severe financial imbalances in the global economy, and I think that's where the danger is going ahead.
Thank you. Thank you, Mr. Bryson. We'll go to Mrs. Bateman, please.
Thank you very much, Mr. Chair, and thank you to all of our witnesses this morning. I really appreciate the discussion that we're having. We heard yesterday from a number of economists, and some of them were speaking about the fact, well, this is just a volatile industry, and there were several of them who spoke to the fact that in '98 we had an adjustment, major adjustment. In '86 we had an adjustment, and the outputs from those adjustments was always greater innovation, greater investments in technology, more effectiveness and efficiency in the industry, and so the industry came out much stronger from the, in quotation marks, crisis. And I would really, I'd like to have your views on that. Perhaps we could start with Mr. Myers.
If you look at the macroeconomic statistics, I think that's you can draw those conclusions. In the meantime, if you look from 2002 to 2012, we've seen 20,000 manufacturing operations go out of business as part of that adjustment. So it's not an easy adjustment there, and it has very important employment effects. Of course, 600,000 fewer people employed in manufacturing, although we're at record levels of production right now. Yeah. So it's those adjustments, while they take place, are extremely painful. But of course, the overall trend is right, and that's why the importance of investment in new technology, importance of investment in new products, the importance of investment in skills, making sure that we're able to attract the product mandates, retain the product mandates here in Canada. That's why that's so. All of that is so important, because that is what eases that adjustment.
Okay. Do you care to speak to that, Mr.? No, that's not your area, Mr. Nantes.
Yes. As you know, in the auto industry, we came out of the dark years of 08 and 09, hurting very badly. Yeah. But it's true, we made some very hard decisions that did result in job losses to the tune of about 40,000 jobs in the auto industry. We took out unused capacity. We became much more productive. So we came out being stronger, yes, but it was with a great deal of pain.
Yeah.
But so too, and I talk about the relativity of what's going on in other jurisdictions, they too went through that phase, and they too now recognize the value of an auto industry and the spin-off jobs of 9 to 1, for instance, which is why they're so aggressively seeking new investment. So yes, we did come out stronger, but as we go forward and we want to keep the mandates here, we're going to have to up our game, and nothing is static in this world anymore, and the competition for investment has never been greater than we've seen. I mean, I've been around long enough to be through a number of these cycles. I've never seen a cycle as deep as 08 and 9, but we run the risk of losing more if we don't up our game.
Okay, thank you. I just want to also follow up on a point, and Mr. Chair, is it all right if I continue, or would you like to have our witness, would you like me to stop so our witness
keep
can
going. Finish your round, please.
Thank you. Mr. Myers, you mentioned the impact in your remarks, 0.3% impact is marginal. You need to continually. Now, I mean, you did speak after that about the need to continually invest in innovation and technology, but the 0.3% impact could you just expand on that?
Sure. Well, I think in terms of potential cost savings, lower price of oil, number one assumption is that would lower energy costs for manufacturing. But energy costs from oil represent only 0.3% of total costs in manufacturing.
Okay.
So that's not really going to mean a big cost savings on the energy side. Potentially greater cost savings as a result of lower feedstock costs in plastics, petrochemicals, refined petroleum products, for some industries in particular. But I have to say, we're not seeing the trucking industry or the rail industry passing along lower energy costs that they're incurring to their customers yet. That may occur over time, but we're certainly not seeing that yet.
Yeah, no, that's it's a very point is well taken. Are you passing on the differences?
Right now, probably a lot of those cost savings are going to be taken and reinvested in better capacity and better productivity, and more people working.
Okay, thank you. I just wanted to follow up, Mr. Walker. You mentioned you're doing a lot of consumer consultation, and I know people in my constituency are pretty darn happy to have $20 to $30 more in their jeans after they fill up than they did previously. And I just wanted to give you a chance to broaden your comments on that.
Just a brief response, please.
There's no doubt that most Canadians are feeling quite good about the fact that they're saving money. It's giving them a positive feeling in that, we'll call that microeconomic context. And the question is in their mind, how long will this last? And they haven't thought a lot about the macroeconomic outside of.
We heard yesterday
Alberta.
from experts that it's not going to last forever. I mean, this is a cyclical industry. Could you speak to that?
Very
just
briefly.
I couldn't speak to it. I'm not an economist, but if it doesn't last, that will, and all other things are equal,
Mr.
and other
Myers can
economic
speak.
indicators go bad,
Sorry,
that's
we're out
not
of
going to be a
time.
good thing.
Thank you. Thank you, Mrs. Bayman. Just, Mr. Stanford, can you hear me in Toronto?
I hear you loud and clear, sir. Can you hear me at your end?
Can, yes. Thank you so much for your patience here this morning. Colleagues,
Not at all. Thank you.
I'm suggesting we take Mr. Stanford's 5-minute presentation and then resume with questioning of witnesses. So, Mr. Stanford, if you want to give us your 5-minute presentation here this morning, and then we'll go back to questions by members.
All right. Thank you very much, Mr. Chair. I'm Jim Stanford, economist with Unifor, which is Canada's largest trade union in the private sector of the economy. We represent members working in over 20 sectors of Canada's economy at all stages of the value-added chain, if you like, from resources to processing, manufacturing, transportation, and services. So our members are feeling the impacts of the change in oil prices, good, bad, and ugly, if you like, in all of those different sectors. I apologize if I repeat anything that was said by the earlier witnesses, and I would refer members of the committee to the brief that we've prepared at Unifor on the many and various effects of the oil price decline. We've prepared for our members. It's on our website, and I think it was passed around at the committee this morning. Obviously, a decline in oil prices by half is a major shock for the Canadian macroeconomy. In my judgment, and I actually did work in another life as an energy economist for a few years before I joined the union movement, my guess is prices are likely to stay at this level or perhaps even lower in the medium term. I don't see any quick change in the global forces which drove the price down to the levels that they did. Also, it's not at all clear the current oil price is low by historical standards. In fact, it's about equal to its 40-year inflation-adjusted average, which suggests the price in recent years was high as opposed to the current price being low, and I think we should shape our response to this on the expectation that prices are likely to stay at current levels or lower for some time to come. As you've heard in your hearings, there's many various and contradictory economic effects from the decline in prices. Petroleum production will not be quickly affected. In fact, Canada's production is going to keep growing in the medium term. We are seeing a major retrenchment of investment in new exploration and development and construction projects in the petroleum sector. And since that sector accounted for 30% of business fixed capital spending in Canada before the decline, that is a major problem for our economy, and there'll be big spin-off effects from that. The real GDP effect will be muted. Extraction will continue to grow. Investment will fall. And some other sectors are going to experience benefits, including consumer spending, benefits for energy-consuming industries, especially in the transportation sector, and to a small degree, as Mr. Myers just said, in manufacturing itself. The impact of lower oil prices on U.S. demand, our major export customer, is unambiguously positive, and that will benefit our economy. There will be some losses among manufacturing companies which supplied the oil and gas industry with manufactured inputs, but as a share of our total manufacturing and activity in Canada, that supply chain linkage was small. The most important beneficial impact, of course, will be the decline in the Canadian dollar, which is now back to its purchasing power parity level. I stress the dollar today is not low. In fact, the dollar is at its appropriate level given relative consumer prices in Canada and elsewhere. There will be significant benefits from a lower dollar, both immediate and in the longer run, on net demand for Canadian-made goods and services in all tradable sectors, not just manufacturing, but also tourism, tradable services. It even helps the petroleum and resource sectors themselves grapple by cushioning some of the impact of the decline in world prices. We're seeing some benefits of that already. For example, Canada's exports of auto parts grew by 15% last year, which is a very encouraging sign for an industry that's experienced a very challenging decade. Some Some caveats regarding the beneficial impact of the lower dollar. First of all, the Canadian dollar has not weakened universally. Our dollar has appreciated against the euro, which is a major competitor in manufacturing markets, appreciated by 15% over the last year. There's been no change in our dollar relative to the Mexican peso, and Mexico is, of course, the largest source of imported automotive products now to Canada, and our currency has appreciated in the last year against the Japanese yen. And while the lower dollar is beneficial, it's clearly not a cure-all for our manufacturing problems, partly because so much capacity was lost during the last decade. It's difficult for the industry to take advantage of this space that the lower dollar provides. Secondly, companies don't know how long the lower dollar is going to last, and I think it is important in this regard for government and the Bank of Canada to indicate their views that in the long run the dollar should not shoot back to levels well above its purchasing power parity. Otherwise, the potential positive impact of a lower dollar in investment decisions will be muted. We would stress very much the need for continuing strong, proactive economic strategies to help key strategic sectors like auto, aerospace, telecommunications equipment, also strategic tradable services like digital media, where we have a lot of uniform members working. That will be part of the response. I think the major economic challenge to Canada's macroeconomy from lower oil prices is going to be the fallout from the retrenchment in petroleum investment, and part of government's response to that can be very strong support for increased investment, both public and private, in other sectors of the economy. Public, that means support for infrastructure spending. Private, that means partnering with industry to boost investment in key sectors, such as those that I mentioned. So I'll leave it at that, Mr. Chair, and look forward to the discussion with the committee members. Thank you very much.
Okay, thank you, Mr. Stanford, for your presentation. We'll continue members' questions avec Monsieur Dion Labelle pour 6 minutes.
Oui, bonjour.
Mr. Dion Labelle for 6 minutes. Good afternoon. My question is for Mr. Mendez. When you introduced your analysis in January relating to monetary policy, the hypothesis was 186 for this cents, and today it's at 78 cents. If you knew at that time the dollar was going to be at a 78-cent level, would that have changed your attitude relative to the lending rate, and would that have changed your prognosis and hypotheses? Thank you very much for your question.
The key thing to keep in mind is that we make a constant assumption for the dollar. As you mentioned, it was 86 cents. Financial conditions more broadly have eased after the monetary policy action in January, including the dollar. That, of course, has an impact on the economic outlook. I can't update you on that right now. We'll update it on April 15th at the next decision date when we release our next monetary policy report.
Vous allez le faire éventuellement.
So you're going to do that eventually? Microphone, please. In relation to the document that you submitted to us, graphic number 15 talks about what's used on the labor market, saying that that's much more important than the unemployment rate. And you have a sentence that seems to contradict somewhat what we generally hear from the government. That is the long-term unemployment rate is at the summit relative to the crisis. Can you make any comments in that regard?
Is trying to take a broader view of the labor market than just what we get from the usual definition of the unemployment rate. So we construct a measure that takes account of longer-term unemployment, underutilization of labor, wage increases. And what we see is that several factors are keeping this broader measure of labor market slack above the level of the unemployment rate. Long-term unemployment is still close to its pre-crisis peak. Average hours worked remains low. The proportion of involuntary part-time workers continues to be elevated, and those factors are keeping this broader measure of labor market slack above the unemployment rate.
Merci de votre réponse.
Thank you for your answer. Mr. Walker, I really liked your illustration in terms of the rocket and the feather example. This is something that we thought about this week in this committee. saying that the lowering of the price at the pump and of the oil barrel price is not proceeding at the same rate. And so we've put forward the idea of having a commissioner that would look at that ratio to see if there is some logic behind it, because if we look at the price of the barrel, it was at 148 and we were paying a 188 at the pump, and now the barrel is at $50, and even last week there was an increase in the price at the pump. So there's something that's not right there in terms of the ratio. What's happening?
Although we do know that some of the players that are in gas retailing are showing higher profits than they've ever shown in the last few months. And so we would applaud the idea of doing some research into this rocket and feather effect. In fact, we at CAA were talking about commissioning our own study and putting it out in the public domain to understand what's going on. And if you see what's going on in pricing in the U.S., it's not so much the rocket and feather. It looks like the prices have gone down close to the proportion that they've gone down in terms of oil prices. So we think there could be something going on in Canada. We think there's probably a worthwhile academic investigation into that question.
I have 1 minute left. Yes, in terms of the Bank of Canada, in terms of liquidity of companies, we remember that Mark Carney, who said that there was a lot of liquidity, and this had been corroborated by former Minister Flaherty. So what are we talking about to the present state of liquidity of companies, where we're talking about an uptick in the manufacturing sector? So do you see that there's going to be an increase in investments by the manufacturing sector, or is the liquidity level staying the same, or is it varied?
To face good financial conditions and have solid balance sheets. That continues to be the case. We do see investment picking up going forward. We're hearing from manufacturers when we talk to them that they do investment intentions have picked up, so have employment intentions. In addition, last year we saw Canada's non-energy exports pick up. We expect that to continue as a result of the stronger U.S. economy and the weaker Canadian dollar. And as that happens, we do expect investment to pick up. Capacity utilization in the manufacturing sector is rising, and as demand continues to grow, that should translate into greater investment.
Mr. Meyer.
Mr. Meyer?
Levels of investment in advanced technology and manufacturing are record levels, even though we have fewer companies in the field. So we are building capacity there. I think as I said before, I think it'll be easier to find skilled workers in the manufacturing sector. That should also be positive and help to allow production to increase. But it's going to continue to take investment in new products, new technology, and the skills training, and that's extremely important for maintaining competitiveness, maintaining growth. And some of the reason why we're not seeing oil prices gas prices come down is because some of the refiners are taking profit. And they're using that profit to reinvest in that better capacity and the improved productivity there too. So I think that's a very important part of what we're seeing right now. And as long as those investments are being made.
Okay. Thank you. I'm going to see Mr. Dion LaBelle. We'll go to Mr. Cannon, please.
Thank you very much to our witnesses, and thanks, Mr. Stanford, for being here. There was some comments about economists you missed out before. They said if you had 5 economists lined up, you get 6 different opinions, but I'm not sure if that's true. I just wanted to verify one of the comments you made earlier. I think a comment was about impact of oil prices on employment. Maybe you could verify what your understanding is from the immediate time and over. We've heard from various witnesses this low oil price situation could be out for a couple of years, so maybe you could give us a prognosis of your understanding of employment levels.
Well, the impact on both aggregate GDP and aggregate employment in Canada's economy will be a mixture of positive and negative effects depending on what sector and what region of the country that you're in. The most negative employment impact of lower oil prices will be felt in the petroleum exploration, development, and construction sectors. And this is where you're going to see immediate job losses in Alberta and other producing regions as the companies dramatically reduce their new spending on investment, exploration, and development. We'll see some positive impacts on employment in other sectors, those that benefit from lower oil prices, stronger consumer spending, the lower dollar, and the boost to demand in our U.S. trading partner. Now, those benefits, I think, tend to be more dispersed than the negative impact in the petroleum exploration sector, so they may not be as visible. But on a net basis, I would expect there to be very little net impact on the overall employment situation from the decline in oil prices.
Thanks. I represent the Okanagan Colonial Lake country. I've been there for about 25 years, but I've spent my first half of my life in Edmonton and the Alberta market, so I know it's had a big impact, especially in that region, as we've heard from other witnesses. I just wanted to know if you still stand by your quote in your January 30th press release, there's less chance of Ottawa reporting a deficit for fiscal 2015-16 than there is of the Maple Leafs winning the Stanley Cup. See how that goes.
Even though the chances of the Maple Leafs winning the Stanley Cup are even more remote than they were then, I fully stand by my quote, Mr. Cannon. Thank you.
All right. Moving on to our Mr. Myers and Mr. Nancy. I appreciate your comments, and I've been on the Trade Committee for over 9 years, and one of the aspects of we've obviously seen a downturn in January with our trade. We had a trade surplus of about $5 billion in 2014. So taking the energy component equation out of the trade perspective, does that dramatically improve the picture for Canadian exporters?
It does, both in terms of volume terms as well as price terms, because for companies that are contracting in U.S. dollars, as the Canadian dollar falls against the U.S. dollar, that will show up as a price increase for the export side, as well as, of course, stronger U.S. economy, lower dollar make Canadian goods relatively more competitive, although, as I think the point's been made, we're also seeing other currencies fall as well. So I think we will see stronger export performance on the sort of the non-energy side of our exports, mainly manufactured products.
You mentioned competitiveness, and productivity is something I hear often from constituents and working with small businesses in our community. How is Canada compared in productivity versus the United States?
Well, according to our statistics, not very well, but I don't think our statistics really measure productivity very well, or manufacturing output, for instance. Very difficult today when companies are competing more on service and customer service. Our GDP numbers don't differentiate very well between that increase in value as a result of service versus just a price increase. So what I look at is the capability of our companies to grow in market share, and that I think is a very, very intensely competitive situation, and there frankly our record has not been all that great over the past 10 years, particularly in the major market we have in the United States. So my answer, in short, is that we need to do more, and companies need to do more in terms of being sure that they're bringing the products, the services that their customers want, and doing that in a way that's competitively priced.
So quickly, I can ask yourself and Mr. Nantis, the RCC, regulatory cooperation and harmonization, we've been working on that, the Automotive Innovation Fund, accelerated capital costs. What else can the government do to help?
Okay, about 1 minute, please.
You go ahead.
Sure.
Mr. Nantis.
Basically, stay the course, but be cognizant of what's going on in other jurisdictions who are aggressively seeking, these new investment decisions. And clearly they have upped their game. They are being very aggressive. So let's continue to keep what we're doing, because it's all extremely helpful and absolutely necessary. But let's be mindful of what's going on around us.
I think the extension of the accelerated depreciation is key, particularly in this budget. The other thing is that around the world, we're seeing a revolution in technologies being used in manufacturing, not only product technologies, but the types of technologies being used in manufacturing processes. And it's really very important that we ensure that our manufacturing sector, particularly small, mid-sized businesses, are adopting those technologies. So more effort in terms of technology demonstration, de-risking the adoption of those technologies, and a part of that is better skills training, better work with universities and colleges to provide more practical experience. All of that is key.
Okay, thank you.
I'd like more on the rocket and feather as well. Thanks.
Thank you. Monsieur Côté, s'il vous plaît.
Merci, Monsieur.
Thank you, Mr. Chairman. Thank you to our witnesses for being here this morning. Mr. Mendez, when I look at things over the last 10 years, I see that the value of the Canadian dollar relative to the American dollar has generally followed the value or the price or the different prices of the barrel on the international markets. And so it changed. It was $1.10 in 2007, following the dramatic fall following the crisis that we went to, and it went down to 76 cents for the American dollar in 2009, and then it went back up. I think that it went back up at the same time as the price of the oil barrel went up. And so would you say that this fluctuation in terms of the Canadian dollar relative to the American dollar is linked to the strength of the American dollar, or rather relating to the overall world price of a barrel of oil, or are the two factors more or less the same in terms of their effect on the Canadian currency?
Factors do have an impact on the currency. As I said in my opening statement, the Canadian dollar does tend to move with the price of oil. That's because we're a net exporter of oil. When oil prices go up, foreigners have to buy more Canadian dollars, basically, to buy our oil or to invest in our oil sector. And so there's a fundamental reason that causes the dollar to move with oil prices.
Mm-hmm. Merci beaucoup.
Thank you very much. Mr. Stanford, in his comments, had stated that it would be preferable to avoid a significant increase in terms of the Canadian dollar relative to the American dollar. But the Bank of Canada has been rather active in intervening in the Canadian economy. Do you think that the Bank of Canada has the capacity to slow down the increase of the Canadian dollar relative to the American dollar when one looks at the cost of the barrel increasing? So could we expect that the Canadian dollar would increase potentially relative to the increase in world oil prices?
Monetary policy is focused on returning inflation to target over the medium term, and the value of the dollar is determined in markets. So, I mean, I think that the focus on inflation is the best contribution that Canadian monetary policy can make to the economic and financial welfare of Canada, because ultimately, attempting to lean against movements in the dollar would force adjustment onto economic activity, employment, prices, and wages within the economy, and in that way create additional volatility, but also undo any of the, or at least some of the impact of leaning against movements in the dollar.
Merci, Monsieur Stanford.
Thank you very much. Mr. Stanford, do you want to make a comment in relation to the fact that the Canadian dollar might increase to summits or be perhaps overvalued according to the increase of the oil prices on the international market?
Yes, sorry, I thought you were directing the earlier question to me, so I apologize for jumping in there. I certainly think this is an important concern going forward, and the fear, I think the legitimate fear, that the dollar may indeed shoot back up if and when oil prices do recover is indeed limiting the beneficial impacts of the lower dollar now on investment decisions. And I do disagree with Mr. Mendez on a couple of points. Number one is the transmission mechanism linking oil prices to the value of the Canadian dollar. Why do those two variables move in tandem? And it is not because of the need for foreigners to buy Canadian dollars to purchase our oil. As you've seen, including from the Bank of Canada's own research, the net demand for all Canadian-made products, energy and non-energy, has declined during the period of the oil boom. And we have gone from a situation of trade surplus into chronic and significant current account deficits. So counting everything that Canadians make, foreigners were buying less of what we make even when the oil price was high. So it is absolutely not a function of demand for the dollar resulting from real purchases of our commodities. I think the transmission mechanism is more through financial assets and the demand among foreign investors for Canadian assets related to the energy sector when the oil price and other commodities prices are high. So through both portfolio investment flows and direct investment flows, that was the mechanism that drove up the dollar, even though our net export performance was deteriorating badly. I think the Bank of Canada and the Government of Canada can both play a role in breaking that link, because our dollar is considered a petrocurrency, but Canada is not by and large a petro economy. Depending on how you measure it, petroleum extraction is only perhaps 5% of our national GDP. So I think the Bank of Canada needs to reconsider its view that it will leave the foreign exchange market alone. Other central banks around the world have intervened quite effectively. The bank clearly has the capacity to do that when the problem is over appreciation. There's no limit to the bank's ability, even indirectly through the bank's positioning statements. And I do notice that Governor Poloz and others have indicated that the narrow focus on inflation rate targeting may not be appropriate anymore. We've learned the hard way that there's other things that the bank has to keep an eye on, including the dollar. The federal government could also play a role by regulating those inflows of foreign capital that are driven by very high oil prices, in particular by, I think, a stronger mechanism for reviewing foreign direct investment in the oil patch when oil prices are shooting up. That, I think, was a key part of the transmission mechanism to a higher dollar.
Thank you. Thank you. Merci, Monsieur Côté. We'll go to Mr. Van Kessel.
Thank you, Chair. Thank you all for being here. And I'm going to throw my favorite quote in from Harry Truman about economists, that he asked for a one-handed or one-armed economist because his economist kept saying, Mr. President, on the one hand, on the other hand. Yeah. I don't think so. Anyway, Mr. Stanford, it's good to see you. And I got to say, we've heard a lot of testimony, and I agree with everything that you said in your opening testimony, and I commend you for that too. I think there's a lot of opposing views, but I share a lot of virtually everything that you said in your opening remarks too, and I'm encouraged by that, because one of the things that I see within this testimony and other testimonies, what the government has been doing is also a recognition from all sides that we need cooperation. And the days are over where we pit the one group against the other. And somebody mentioned in their testimony, I think it was you, Mr. Myers, talked about the need for universities and colleges to work in conjunction with industry. And those are maybe I'm a dreamer, but those are things that I believe that are going to happen in this country. And increasingly, there's an appetite for that. So I commend you for your testimony. I'm going to do a little dig, Jim, if you don't mind. One of the things I think the biggest mistake, personally, I feel that we made in the automotive sector back in the 80s and the 90s was when we had the lower dollar, that we leveraged that against the automakers, and we demanded higher rates, and I hope that the union sees that. I believe that you, just listening to your testimony, that you recognize the importance of a lower dollar, or the advantage that we have, and I hope that we don't blow that like we did the last time too. So just an encouragement on your part. I wanted to just make mention too about was mentioned, Mr. Walker, you talked about the possibility of possibly looking into the oil prices. I got to say that's been done a number of times, and there is a competition bureau. However, and when it has been studied in committee, there's representation from all sides, and I know that at each particular committee, committee members walk away and say, I guess this is explained. But I like what you said too, Jason, about the fact that they're going to use that money, and they're going to use that money for investment. Again, I think we need to reiterate that that is a corporate decision. I don't know if we want to get into the position where governments will tell businesses what to do. I think we need that cooperation. So that's my little spiel. I just wanted to say that I see we're seeing some agreement across the board there too. Jason, I wonder if you could and just talk about the importance of the recent and maybe we could go to you as well too, Mark. Just talk about the what has happened to the auto industry and how it has positively affected. Because I remember back in 2006, they said we needed a bridge, we needed harmonization, we needed all those things you're talking about. And just tell us how that has strengthened our position in the auto industry. And I'll leave it to either one of you to start. Mark,
maybe I'll start, Jay. Had those things not occurred and continue to happen, I can say with a great deal of confidence the most recent investments would not have happened. That's very clear. So the question is, and I've talked about upping our game, and so we need to capitalize on what we have. But when you look at the packages of incentives that other jurisdictions are putting together, they are massive. And we obviously, I don't think we have the wherewithal to match dollar for dollar that type of thing, but we have to be mindful of that, and we have to put together the best package that we can. And what has happened over the last 3 months with the very positive announcements, I can't say is going to happen in the next 3 years. But we are at a point in time where we are in another investment cycle now, and that's going to be driven by regulatory issues such as greenhouse gas regulations and so forth. It'll be probably the most significant advancement of technology in motor vehicles that has ever occurred in our history. And as Jay mentions, this does translate into our ability to produce these vehicles and the technology that goes on to the shop floor to build them. It'll be a very different game as we go forward. So it's very critical that we maintain what we're doing, as I mentioned. But we need to look at things like, is the Automotive Investment Fund a permanent thing? Because certainty is very critical in terms of investment decisions in the long term. We need to look at SR and ED tax credits and how we can best use unused credits, et cetera. All of the accelerated capital costs, these are all things that are not just useful and necessary for auto industry, but for manufacturing generally. So we've come out of that recession, with a great deal of new capacity. We are operating at maximum capacity right now. And to move forward, we need to look at these additional things.
Jake?
And maybe just focus on 3 key points. One is the need to secure a new investment in terms of assembly, because that drives the auto supply chain, and the movement of assembly down in the southern states and Mexico means that we've lost a lot of the potential for growth here in Canada. So the to secure a new investment there is critical. Second thing is that the entire auto industry is going through some pretty big technological changes in response to regulatory requirements around emissions, driving lightweighting, smart vehicles, all of this stuff. We have to make sure that our auto parts industry in particular keeps up with that technology, and I think that those investments in R&D and new technology are critical. Third thing, of course, is that our auto parts industry and the vehicle industry, assembly industry, is a global industry, so trade, regulatory cooperation, making sure that we have trade remedies in place so that we can effectively enforce the trade rules of our trade agreements, extremely important, as is the new opportunity.
Thank you. Thank you, Mr. Frankester. And Mr. Adler, please, for your round.
Thank you very much, Chair. Thanks all the witnesses today for being here. I do want to begin just by saying that the challenge of any government is how they deal with events. And one unforeseen event, of course, was the drop in the global price of oil. I want to ask first Mr. Myers, how important and what kind of a role has our economic record as a government played in the unforeseen drop in global oil prices? I mean, you remember when we first came into government, we paid down a massive amount of public debt. We're going to be the first government, the G7, to balance our budget. We've created 1.2 million new jobs since the depths of the recession. We have the lowest net debt to GDP ratio of any country in the G7. How important are those factors in light of what we see in the global scene right now in terms of lower oil prices, and how that's protected us or cushioned the potential blow that this could have obviously had if we were in a weaker position?
Well, look, I think the improved fiscal situation, the steps that have been taken to encourage companies to make investments in productive assets and to be more flexible, I think the response of the Bank of Canada, all of that, which has been enabled by a lot of the improvement on the fiscal side, all of that, I think, has been very positive in being able to cushion the Canadian economy against the rapid plunge in oil prices. As I said before, I don't think this is an economic crisis for the Canadian economy. I think there are bigger risks out there in terms of the global financial economy, and in that situation, I think Canada is very well positioned with respect to our fiscal situation, our debt situation.
Thank you. Now, I mean, certainly this is a, and Mr. Nantes or Mr. Myers, either one of you can jump in on this one. Your members are producers of goods and services, and clearly this is I think a lot of people are fixated on price. And why aren't we seeing, with this drop in oil prices, historically we've seen a lot of layoffs that would follow. We're not seeing that now. Why do you suppose that is? Maybe Mr. Nantes.
I can maybe speak at least to the auto industry.
Yeah.
As I mentioned, first off, investment decisions are in the long term. These short term, impacts of the price of oil, for instance, aren't really major factors. If it tends to be a long-term trend, that may be a different story, and that long-term trend will make a difference. But when we develop new vehicles, we respond, and with the fact that we export 85% of those to U.S. U.S. continues, as reported repeatedly here, that they're going to be greater disposable income. They will, of course, use that the benefit of that to purchase new goods, and those are the goods that we export primarily. So we're at capacity, and as long as we continue to benefit from that additional disposable income, export products that they're demanding, then we'll be in fair shape. The longer term may be a different story, and we have economists that are, and we all have economists that are looking at these details very closely to look for changing, directions and trends. So for the moment, we respond to the demand, and demand is there.
Thank you.
And I'd say, really, I think reiterating what Jim said too, we're seeing sectoral and regional impacts on unemployment and on economic activity, particularly for the suppliers of the oil exploration, oil drilling, oil sand sectors, which has a pretty large range right across the country, but particularly in Western Canada. So we are seeing that there. And also the services that are wrapped around that, retail side, real estate, for example, in Western Canada. But to some extent, there's a saving grace in that it is becoming more easier to find people with the skills and particularly in trade sector, which is the number one constraint on growth for manufacturing across the country. So there is a positive impact here as well, and that may be, I agree with Mark, these are longer term changes, and it will take some time to adjust. But I don't see a major downturn in employment, particularly on the part of skilled trades that are no longer in the construction field. And with respect to oil, I think they'll be easily, there's a lot of demand for those type of people across the country.
Companies like airlines, that sort of thing. I mean, nobody saw this coming in terms of the precipitous drop in the price of global oil. Were there companies that were, when the price started to drop, to buffer themselves against any potential increase, because nobody saw it dropping as much as it did, were there companies that shorted and bought oil, let's say, 100, 110, locked in for the next year or so?
And brief response.
Yes, and that's a major issue in the short term, because you have a lot of companies that have bought oil or other commodities bought high, even high in terms of a higher Canadian dollar, and now as the Canadian dollar has dropped, they're left with materials and inventory that are relatively highly priced here. So in the short term, that is a problem, and it really has an impact on operating cash, and is one of the problems we're seeing right now in that adjustment.
Okay, thank you, Mr. Adler. Colleagues, I have a couple of questions, but I have a request from Mr. Bryson, because he had a question for Mr. Stanford, and we didn't have the video conference set up, so he's asking for consent of the committee to ask one 30-second question, and maybe a minute for the answer for Mr. Stanford. Okay. And I'm sure it'll be a very nice, polite question, Mr. Bryson.
Absolutely. Well, Mr. Stanford and I have been kicking around these parts for some time, so it's always good to hear from him. Mr. Stanford, you made reference to the fact that oil prices are not actually at an abnormal level given historic pricing of commodities. And given the volatile nature of oil prices and commodity prices, do you think that the federal government has focused too narrowly on this one sector and potentially put all its eggs in one basket over the last several years? Is it good fiscal policy to build your fiscal framework around $100 a barrel WTI oil?
Okay, just a brief response.
Thank you. Well, to the extent that our fiscal plans and our economic strategies were premised on the expectation that the oil price was high and going one way, and that we would be an energy superpower, and that this would drive our whole economy forward, then I think that was a mistake. Now, in reality, there were many other things, of course, that were being done. So we never, as a country, put all our eggs in the oil basket, nor should we have. But I think, at least in our rhetoric and to some extent in our policy, we emphasized too much that one sector and underestimated the importance of maintaining diversity in our economy and maximizing the value-added links to that natural resource sector. We wasted huge opportunities using the growth in resources to leverage more demand for Canadian manufactured goods, for Canadian-made services and other inputs to get more bang from the buck. One good example of that has been how we've treated our petroleum refining industry. You'll see the graph in the handout shows that real GDP in refining has actually declined since 2002 by over 10%. We should actually be focusing on getting more value added out of our resource and less of a belief that pure extraction will save the day for us.
Thank you.
Thank you.
Mr. Stanford, Mr. Bryson, I'm going to pose, I guess I'll just have time for one question. Mr. Myers, I wanted to follow up. First of all, I thought your point, lower oil prices will result in a very small reduction in energy costs. That's a very interesting point I just wanted to highlight. Secondly, you talk about the rapid depreciation of the Canadian dollar has increased the cost of imported materials, parts, and equipment for manufacturers across Canada. In the short term, many companies are caught with higher input costs without offsetting revenue benefits. I wanted you to expand on that and perhaps address the question, did the Canadian manufacturing sector and companies, did they take advantage of when the dollar was near parity in terms of upgrading their equipment? You talked about investing in skills equipment, new products. Did they invest in new equipment? And then perhaps link into the much broader policy issue, which we hear a lot about, which is companies were sort of sitting on cash, to use a sort of colloquial expression. Can you address that?
Sure. Well, I think it all comes down to all the impacts on cash flow. Right now, in the short term, for companies that are caught with high inventory costs, high materials costs right now, and aren't able to take advantage of a lower dollar immediately, that does eat into their cash flow and their operating cash, and may over a period of time kind of work out because they'll be selling at a lower dollar and making more Canadian dollars. So that there is an offsetting benefit there. But to your it's very difficult for any company, let alone any government, to do any forecasting around prices or currencies here. And it was only, this is a dismal profession. I remember it was only a few years ago that some economists, and I don't want to say some of us, some economists were predicting $200 a barrel price of oil. So it's very difficult for anybody to, and particularly when contracts are set over a long period of time. So the price volatility, currency volatility does really affect cash flow, and usually negatively until adjustments can be made. But to your major point about, we hear a lot about companies sitting on cash, and in fact they are in their balance sheets. Cash is more in their balance sheets, but that's like saying, you know, you've got more cash in your RSP. You're not going to necessarily spend that, nor should you be spending that cash immediately. What drives investment is operating cash, which is usually after-tax profits plus depreciation, and that's why the accelerated capital cost allowance is so important, because it drives the cash flow that drives the investment. And right now, you know, really since 2011. We're seeing record levels of investment in machinery and equipment, usually productive new technologies on the part of manufacturers. A lot of that is attributable to the accelerated depreciation that has been in effect since 2007. So it's the operating cash drives the investment, and so all of these changes in prices and in currency values will also be affecting in a very volatile way that cash flow. But I think it's very important that we continue to encourage the productive use, productive investment from that cash, rather than just simply a distribution of dividends.
Thank you. I'm sorry it's a very interesting topic. I'd like to continue, but unfortunately we are at the end of our first panel here, and I'll just point out this committee has recommended the extension of the ACCA. So our work going back to 2007 has paid some benefits. I don't know when a temporary becomes permanent from 2007, but we'll see on that. Thank you so much for being here, and Mr. Stanford for being with us in Toronto, and your patience in setting up the video conference. We appreciate all of your comments and responses. If you have anything further, please do submit it. We'll ensure all committee members get it. So, colleagues, we'll suspend for a minute or two here. I call this meeting back to order. I'll encourage colleagues and everyone to find their seats, please. We are continuing with our study of the impact of low oil prices on the Canadian economy. Order. And colleagues, I understand there is a vote in the House in an hour, so I'm not exactly sure how we're going to proceed here, but we'll do as much as we can before that vote and see whether we can come back. We have, first of all, we have from the Automotive Parts Manufacturers Association, the president, Mr. Flavio Volpe. Am I getting your name correct? Okay, welcome. We have from the Canadian Labour Congress, we have the senior economist, Ms. Angela McEwen. Welcome back. We have from the Forest Products Association of Canada, the executive vice president, Mr. Catherine Cobden. Welcome back to the committee. From the Canadian Steel Producers Association, we have the president, Mr. Ron Watkins. Welcome to you. And from Fort McMurray, we have the mayor of the regional municipality of Wood Buffalo, Ms. Melissa Blake. Melissa, can you hear me? Can you hear me okay?
Sorry. Yes, I can. Thanks.
Okay, welcome. Thank you for being with us from Alberta this morning. So you will each have 5 minutes for an opening statement, and then we'll go to questions from members. We'll begin with Mr. Volpe, please.
Thank you. Good morning, committee chair and honorable members. Pleased to join you today and would like to thank you for this opportunity to share with you our views and perspectives on the effect of oil price fluctuation and the consequent foreign exchange rate has on Ontario on automotive parts manufacturing sector. To start, please allow me to introduce the Auto Parts Manufacturers Association. The APMA is Canada's national association representing OEM producers of parts, equipment, tools, supplies, and services for the worldwide automotive industry. The association was founded in 1952, and its members account for 90% of independent parts production in Canada. In 2013, automotive parts shipments were over $25 billion, and the industry employment level was over 80,000 people. Much has been made about the material decline in the spot value of oil in recent months and its consequent effect on the value of the Canadian currency, especially against its American equivalent. While creating a disadvantage for anyone importing American finished goods, the common position is that Canadian exporters have accrued an advantage over the immediate short term. The biggest exporting Canadian manufacturing sector is automotive, and the most diverse, job-intensive subsector of that business is the automotive parts manufacturing. Approximately 500 independent companies in Canada manufacture parts for original equipment manufacturers' assembly operations at home and abroad. Parts manufacturers deal with currency risk, management and manipulation, and export finished goods as a matter of course. We're here today to contribute to your committee's analysis because we believe the benefits accruing from the currently advantageous Canada-U.S. foreign exchange rate is neither permanent nor structural in automotive parts manufacturing sector. Furthermore, from a long-term planning perspective, the longer the currency valuation outlook remains pessimistic, the more likely that OEM forecasting modelers will be planning to benefit from Canadian purchasing while ignoring escalating U.S. dollar-based input costs that develop at the same time. Most parts manufacturers fall into a similar band with EBITDA margins running from 8 to 12% and gross margins in the 15 to 20% range. The major inputs to a typical system supplier or heavy manufacturing North American plant would be raw materials such as steel or resin, components from the lower tiers of suppliers, direct labor, and plant overhead. While raw materials and lower tier components as a percentage of sales can vary depending on the nature of the product being produced, one can generalize that they likely represent in the range of 50% of the cost of sales. For most suppliers, the underlying currency of these key input costs is predominantly the U.S. dollar. While the drop in oil prices, however, has reduced the input costs of some non-specialized resin supply in the market, complex resins used in higher value-added applications remain relatively unaffected. Direct labor, of course, for a Canadian supplier operating in Canada is clearly denominated in Canadian currency. In the automotive parts sector, that typically constitutes about 10% of the sales costs, a relatively smaller cost compared to raw materials. And I should note, lower percentage of cost than final assemblers. Plant overhead is a mix of Canadian foreign currency-based exposure. Canadian-based costs include electricity, indirect labor, and local services. However, virtually all specialized and heavy machinery and ancillary equipment is based in U.S. or Euro currency costs, and these costs typically run in the 15 to 20% of sales costs, with approximately half of that being Canadian currency. If we take these figures together as a a typical volume-based auto parts supplier's cost breakdown, a supplier would have U.S. dollar content in the 50 to 65% range of cost of sales. On the revenue side of the ledger, the transacting currency typically differs by OEM, but most manufacturers would see a majority of the percentage of sales in U.S. dollars. However, increasingly during the recent term of Canadian currency overvaluation of the last 5 to 10 years, many OEMs have begun the practice of pricing directly in Canadian dollars at the time of sourcing. Those plants do not benefit at all from the Canadian dollar devaluation.
Okay, about 1 minute remaining.
Sure. While programs priced in U.S. dollars are benefiting in the short to mid-term, they would typically see some of these gains retracted through the business planning process and purchasing repricing from their OEM customers. Many suppliers with multiple operations and OEM customers have adopted hedging programs to reduce their exposure, but the success of those mechanisms are difficult to forecast because cash flows from any given product program are based on future volume estimates, and history has shown that they fluctuate materially. I'll save you the rest on multi-jurisdictional exposure, only to say a lot of Canadian companies have U.S. plants as well, and they operate Mexican plants. Canadian-based plants in those portfolios are doing well against their American plants. But, of course, as we compete with the Mexican operations, the Canadian dollar and the peso have kept pace, and there's a lot of other dynamics that come to play, and foreign exchange isn't one of them.
Okay, thank you. Thank you for your presentation. We'll hear from Ms. McEwen, please.
Thank you. I'd like to thank the committee for taking this study on. We think it's very important, and thank you for inviting the Canadian Labour Congress. I'm here on behalf of 3.3 million members of the Canadian Labour Congress, and we bring together workers from virtually all sectors in the Canadian economy, in all occupations, and in all parts of Canada. So I'm going to be speaking from that perspective. It has long been the position of the CLC that Canada has had an over-reliance on unprocessed and semi-processed resource exports, and that has had a negative impact on productivity. We heard Jim Stanford earlier talking about the need for making linkages between stuff that we pull out of the ground and stuff that we sell. As a result of globalization and unfavorable trade deals, a high dollar, and a devastating recession, manufacturing in Ontario especially has experienced devastating losses over the past decade. Coming out of the recession, business investments in manufacturing and other areas have been very slow to rebound. In October 2014, the Monetary Policy Report released by the Bank of Canada suggests that this is because of a semi-permanent loss of capacity in several manufacturing export sectors, and that we should not expect to see business investment and hiring pick up until it was clear that the Canadian economy was on more solid footing. That was before the price of oil collapsed. And in the context of what is going to happen to manufacturing, normally if the price of oil collapses, the dollar lowers. That's better for export sectors. But this indicates that we don't necessarily have the capacity for those export and manufacturing sectors to pick up the slack and carry the economy forward. Given that context, it's the opinion of the Canadian Labour Congress that the lower price of oil will be a net negative for the Canadian economy, as the lower dollar will be insufficient to spur new business investment. We've also pointed out several times that corporate tax cuts have failed to spur new business investment. And if we look at the GDP data released for the fourth quarter of 2014, it's clear that there were areas of weakness showing in the economy even before the full impact of oil prices were felt. These include continued dependence on consumer spending to drive economic growth. In that quarter, it grew 2% on an annualized basis. In that quarter, we saw decreases in machinery and equipment investments. We saw an export of goods falling 2.5% on an annualized basis. And we saw growth also hinging on a buildup of inventories. So one of the mechanisms that we think we will see the impact of the falling price of oil is as private sector companies and public sector, such as the province of Alberta, specifically hard-hit oil provinces, cut back their own public investment. So we see a shrinking potential output, which will lead to increased unemployment. So to compensate for this lack of investment in the Canadian economy and to respond to the additional negative impact that the falling price of oil will have on the Canadian economy, the Canadian Labour Congress calls for a major public investment program to create good jobs, to promote our environmental goals, to stimulate new private sector investment, and to boost overall productivity. The International Monetary Fund in October 2014 suggests that the time was right for Canada to make some much-needed infrastructure investments. I've testified before the committee about these investments before. Clearly identified infrastructure needs could be financed through borrowing without increasing our debt-to-GDP ratios, since the types of public infrastructure investment we're calling for increases growth both in the short term and in the long term. Encouraging value-added production investment in key sectors, along with green job and green skills initiatives, will enhance innovation and labor productivity. This initiative will also require active government strategies on trade, sectoral development, and domestic procurement strategies. Having a sectoral development policy which seeks to promote more investment, production, employment, and exports, especially in a diversity of sectors in the economy, is key to attaining a more desirable sectoral mix and a greater share of output and employment. Thank you.
Thank you very much for your presentation. We'll now hear from the Forest Products Association of Canada, please.
Thank you very much. I appreciate the opportunity to be here. My name is Catherine Cobden. I'm the Executive Vice President of the Forest Products Association of Canada. To begin, I'd like to remind you that Canada enjoys one of the largest and best managed forest baskets, fiber baskets in the world. We have a significant manufacturing presence, and we have 235,000 Canadians that have great jobs in the rural economy. A drop in oil price has been of benefit to our industry in the short term. We've had some lower manufacturing cost improvements, and we see a favorable exchange rate that certainly helps us with our main market in the U.S. Our prospects look better than a year ago. The recovery of the U.S. economy is taking hold. For example, U.S. housing starts have now hit the important 1 million mark. But the recovery is still slower than we had anticipated and hoped. Our exports have grown by roughly 10% over the last year. And we also foresee, in the longer term, significant growth potential for most of our forest products, such as pulp, lumber, tissue, bioproducts, etc. But I have to remind you of the difficult times we faced in the last decade. It actually translated to half of our global market was lost. I don't need to remind you of the story. You all know the story. We've been before this committee many times to describe it. So while our exports are inching up and we're pleased to see some of this progress, we still have work to do to capture the lost ground and, frankly, to capture our rightful place in supplying that growing global growth and demand that's out there. I hope that it's Canada that supplies it, not, for example, the Brazilians. So the sector is busy transforming and innovating, and we have done so significantly in partnership with governments. We've been retooling our operations, and we're very proud to boast the best productivity levels in the country. We've been expanding our marketplace. We're very proud to be Canada's largest exporter to China. We've been deepening our world-leading environmental performances, and recently we're so pleased that global polling of our customers demonstrated that Canadian forest practices are viewed as the very best out there. And indeed, as I think this committee is well aware, we've been investing in new technologies and products to add more value into the Canadian forest product offerings. So as we move forward, however, we really feel we must not take anything for granted. We must remember that the benefit of low oil prices are really, frankly, only temporary. We must recognize that exchange rates all over the world are devaluing against the U.S. dollar, and some of our major competing environments are experiencing favorable rates much, much better than our own. And I brought a little prop, which I will make sure that I leave with the committee, on the currency of our competing jurisdictions and how it relates to the Canadian dollar. And of course, I talked about global growth, and I see that there's major investments going on in our competing jurisdictions, such as Brazil, Finland, and Sweden, and they're readying to capture that growth. So we need to respond. So how do we respond? Well, I suggest we double down and we keep doing what we've been doing. We have been focusing on transformation, and we've been focusing on innovation. We've been building a strong partnership, and we have great strengths. Our world-leading environmental credentials, our world-class fiber quality, our trade agreements, our innovation expertise. We have an innovation system like no other country in the forest industry. We must build on these advantages and recognize that we are in a global race with competing nations, not just competing industries. So the drop in oil pricing and the dollar does not give us room for complacency. I would remind the committee about our past discussions for the need to continue our partnership on innovation, continue our partnership on market activities, on trade agreements, on transformational support that will propel the sector forward. It's a challenge we can take on together. We will reach our potential. We will create great jobs, and we will prosper. Thank you.
Thank you very much for your presentation. We'll go to Mr. Watkins, please.
I want to vote for you.
Order. Okay.
It's a compelling situation.
Okay.
Can't top that.
Mr. Watkins has the floor, please. Mr. Watkins.
Thank you, Mr. Chairman, and good morning, committee members and fellow witnesses. I appreciate this opportunity to appear before you today. My name is Ron Watkins. I'm president of the Canadian Steel Producers Association, an industry with annual shipments in the $12 to $14 billion range, employing some 18,000 people in Canada. We operate steel mills in Alberta through to Quebec, and with other parts of the steel industry, we're an economic force across the country. Today, the focus of this committee is the impact of sharply lower oil prices on the manufacturing sector. You've heard from many experts already, including this morning's panel, with multiple perspectives. So I'll provide you our views from the point of view of the Canadian steel industry. First, regarding the potential impact on our own production costs, we foresee modest net benefits at best. Our processes run primarily on natural gas and electricity, and the cost of the latter especially remains relatively high in Canada. Secondly, lower priced oil could reduce our transportation costs, although that is contingent on those pass-throughs from the shippers. We've yet to experience that. However, key point here, Canada is not an energy island. Our competitors in other jurisdictions are also experiencing lower energy prices, and so our relative energy cost differential has not shifted as much as absolute costs have. And I think we've heard similar observations on exchange rate movements globally as well as within North America. Second, regarding the potential impacts of lower oil prices on our customers, and particularly our manufacturing customers, there's a range of factors at play in various sectors, as you heard already today from other experts. Associated exchange rate effects can help exports, certainly, but they also increase input costs. Structurally, the erosion of the Canadian manufacturing base, so this is a prime customer for our industry, over the past few years will not suddenly nor easily be reversed by short-term shifts in input costs. Plants that closed will not reopen, nor be quickly replaced. Manufacturing investment needs sustainable medium-term economic conditions and supportive public policies. That is why our industry consistently advocates pro-manufacturing policies across a range of policy fields. This includes the long-term extension of the accelerated capital cost allowance. We appreciate this committee's support for that, and competitive tax rates. It is also why we emphasize strong trade remedy laws to ensure fair competition in our own market to counter the injury from dumped and subsidized imports, as recent rulings of the Canadian International Trade Tribunal have demonstrated. Third, and very importantly for our sector, decreased capital spending in the energy sector will have a direct negative impact on the demand for steel products. For us, energy is much more than a cost factor. It's a vital customer for a wide range of steel products. Construction materials, fabricated structures, drilling equipment, processing plants, storage facilities, and of course pipelines and rail cars to get Canadian oil and gas products to domestic and export markets. Mayor Blake can probably speak better than I to the range and volumes of steel that moves through her community, and I look forward to her testimony too. The energy-steel relationship embodies supply chains that stretch across Canada, beginning with iron ore that is mined in Quebec or recycled steel from multiple sources. These materials are then transformed into steel in several provinces, then formed into pipe and tube and multiple other steel products for exploring, developing, processing, and transporting oil and gas resources. In doing so, we employ thousands of people directly and indirectly in well-paid industrial jobs. And when the energy sector is growing, so do these opportunities. But the converse, of course, is also true, as we have seen already with hundreds of recent layoffs in our industry. In this key respect, the decline in oil prices has direct negative impact on Canadian manufacturing, and in turn on our own suppliers. So to summarize, lower oil prices are in no way a silver bullet for an expansion of Canadian manufacturing, certainly not for our industry, particularly because of the impacts on energy sector demand. We need to look to the medium-term outlook for both energy costs and other structural factors that ultimately drive investment decisions. Finally, it remains important that government policies across a range of factors help to set investment conditions that will strengthen the major supply chains that we serve, including the energy sector itself. In closing, Mr. Chairman, our industry feels that Canadians really need to be dissuaded from this false dichotomy between manufacturing and energy, or worse still, between West and East. The two industries are integrated through cross-country supply chains. More broadly, we continue to encourage this committee to focus on the structural policies that will contribute to investment and production in each of the supply chains we serve. Thank you very much, Mr. Chairman.
Thank you very much for your presentation. We'll now go to Mayor Blake in Fort McMurray, please.
Good morning, and thank you, Mr. Chair, and thank you to the committee, the members of the committee, for this invitation to appear and share a community perspective on this global issue. Certainly, it's going to be different than the ones you've heard before. The regional municipality of Wood Buffalo consists of 10 communities and 66,000 square kilometers in northeastern Alberta. We are home to 5 First Nations, several Métis locals, and many different nationalities, with over 156 different languages spoken in the homes of our school population. In 2012 census, we identified a resident population of 77,000 and some additional 39,000 guest workers who live on-site in project accommodations. They come from all over Canada to work in the oil sands and then take their paychecks back home, wherever that is, and that brings our population up to about 116,000. We are well educated and earn an average household income of about $190,000 per year. Unemployment is 3.8%, and yet there is a notable wage gap. The average age is 32, and just over half of our citizens are under the age of 35. And in fact, over the last 5 years, our local hospital has delivered anywhere from 1,100 to 1,400 new babies each year. Ladies and gentlemen of the committee, when I say that we've seen this before, what I mean is that we've seen variations of this before. When our region experiences a downturn, we find a way to take advantage of that. In mid-2008, we had our first breather since the rush of new oil sand development took hold a decade before. We had a chance then to catch up, a chance to plan, a chance to get ready for what was coming next. And what came next was a very busy rebound. Even today, we have $21 billion in oil sands projects that are already approved, $4 billion that are in various forms of construction, and another $26.5 billion in applications. And yet that capital spending pales in comparison to what these companies will spend in operations over the life of each of those projects. Each and every year forward, that combined value will grow up from the approximate $5.3 billion that it was in 2012. On the ground, people are still working and living normal lives. They're going to doctors and taking kids to sports and arts and anything else that kids will do. They are still getting groceries and going out for meals and even traveling, though they may be more carefully considering large purchases like cars, trucks, or RVs. Businesses vary, and those that have exclusive ties to industry are further constrained and being asked to do more with less. There have been local business layoffs, and there have been layoffs, but local businesses are in fact still hiring. The nonprofit sector is long familiar with doing more with less, but now it is strained even further. Our food bank use was up 75% this January over last, and our February numbers are worse. So I say thankfully we're a community that cares, and we will be able to overcome these challenges. My council approved the 2015 budget with the expectation indication that we would not need to raise taxes. 4 months later, we are revisiting the capital projects and discretionary spending to ensure fiscal prudence in changing economic times. Our local economy and the contractors within certainly do need projects to bid on. In times like these, it's how we help keep people working, and Canada's investment in infrastructure helps us keep these projects on our books and those people working in our communities. And our community is really still just catching up from the more than doubling of our population since the year 2000. The work is real and it is truly needed. So is the need to curb inflation, reset expectations, and achieve greater efficiency in the industry. But experience tells me that it is really hard predicting the price of oil in either direction. From a community perspective, the rapid upswings can be even more difficult than what we're currently experiencing. While these are challenging times, there remains a great deal of confidence in our local community. We take a long-term view, and we remain optimistic that we will see a rebound someday, and that we will once again change our economic outlook and activities. To conclude, I believe the need for energy will never cease. I believe that the oil sands will remain an important contributor in satisfying global demand. And I know humanity must adapt and innovate in an ever-changing world. I also know that we must work together to ensure that my home, my community, my people are able to survive, thrive, and prosper for ourselves and for our nation. We've come through darker economic days of our past even stronger than before, and I believe that we will do that again this time too. But believe me when I tell you that you simply have to see this place before you believe anything at all about it. Thank you very much for the opportunity, and I certainly look forward to any questions.
Thank you very much, Mayor Blake, for your presentation. Colleagues will begin members' questions. We'll do 6-minute rounds again with Mr. Cullen, please.
Chair, can I just check in on process?
Process. So, colleagues, yesterday we did have a couple of members stay through the vote. They sort of paired. We could do that again.
When are we expecting votes?
The votes will be about 11, 17, 20.
Okay.
So,
okay.
I mean, we have one vote, I understand it, so we could go vote and come back.
Yeah.
Or,
so I apologize to witnesses. We're keen to hear your testimony and ask you questions. We keep getting interrupted by the affairs in the House and some votes. So
can I get the sense, do a few members want to pair and stay, or does everyone want to go vote?
What is the vote? That would be an important thing to know. It's a time allocation vote. I'd be prepared again to stay.
Okay, well.
It's a vote on Bill S7. Zero tolerance for barbarian.
Everybody wants time allocation on the bill?
Okay.
No, yeah.
Yes, okay. Sorry, Chair. I just wanted to.
Okay, Mr. Cullen.
Thank you again. Thank you, Mayor Blake, as well. Perhaps I'll start with you. I have been to your beautiful community a number of years ago, and we talked about development, you and I, and the pace and scale of development. I think a detached home was going somewhere north of, for a two-bedroom, was $800,000-something at the time. I don't know how. I imagine housing prices may have returned somewhat to this universe. Just a curiosity, are you hearing from folks? Has there been a decline at all in the amount of temporary foreign workers that have been going through Fort McMurray, or is that not something that you would hear about through the employers in the industry?
Only random stories that I would get, and the fact of the matter remains the temporary foreign worker program has been the most significant benefit to our hospitality and retail and service sector in this community, because we simply were not able to bring in enough Canadians to fill the jobs that we had. When I mentioned a wage gap, that's one of the big differences that we experience here. So the cost of housing is one of those influences. The cost of living is a little bit higher, and even though these jobs exist in the community, it's tough to get people to be able to integrate here and accept them.
Sure. We also believe in a strong immigration program, so that if we're in need of workers in Canada, that there should be a path to citizenship. That was something that you and I spoke of as well. I think you spoke in favor of it when we did. Just something you said just towards the end of your presentation about the Council revisiting the budget. when did you set, I don't want to get into details of the municipality's affairs, but you set a budget as the price of oil was dropping, or when does your cycle happen that the council would set its budget?
We did. On December 12th is when we approved our budget for the 2015 year. So we did know or have an awareness at that time. We were stringent in the projects that we had reviewed, but at this point there's so much consideration in the community about how we might be able to trim things up, maybe delay, and ensure that every project that we have is suiting the population that is actually here as opposed to the ones that are yet to come. Right. Where the future is sort of more nebulous to us is the reason.
So just not, I don't want to put words in your mouth, but the council goes through and then reconsiders commitments it's making or has made in that budget cycle, given the current context of $50 a barrel oil.
Indeed, and I'm not quite certain whether changes will actually be made. It'll happen within the next few weeks, but it's a matter of just making sure that everything that we have is still what we want to have.
Excellent, thank you. Turn to Ms. McEwen for a second. One of the things we're hearing is not so much that $50 oil and an 80-cent approximate is the new normal, but much more a return to normal in a sense, that the 40-year average on oil is about this price, that the loonie may be somewhere closer to its true global value and is appreciated against other currencies, just not against the U.S. One thing that concerns me, and part of the impetus for this study, was that traditionally, in previous drops in oil, the loonie also fell and manufacturing picked up, so that the net impact across the Canadian economy may have been hard in communities like Ms. Blake's before, yet there would be a consequent rise in others. But that we're hearing from some of the manufacturing sector that might not be the case, that there may be something structural happening, that those manufacturing jobs are not returning with a robust U.S. economy and a lower Canadian dollar. Is that something that your union has occupied itself with? First of all, am I reading the situation right? And secondly, is there something structural that's happened in the manufacturing sector in which we're not seeing the return to work of those value-added jobs? And is there anything we can do about it?
So I take the Governor of the Bank of Canada, Stephen Pulitz, and what they've put out very seriously, and where they've said there has been a loss of capacity in the manufacturing sector in Ontario. And since we're coming out of a recession where there hasn't been a buildup in machinery and equipment because people were cutting back, there has been complete loss of capacity. Plants have been just shut down. So now is with the dollar low, is a bad time to be importing machinery and upgrading, right? So since they were already operating at capacity, we're not going to see a lot of upgrading. And it may not make sense for them unless they're sure that this dollar is going to stick around for a long time, because many manufacturers were burned when the dollar rose. So they may not want to set their business plan on an 80-cent dollar for a long term. So yes, that's something that we're concerned about. Things that we talk about are tax treatment of investment in equipment, appreciated depreciation, that kind of thing. And basically public sector infrastructure in green, transitioning to that green economy, because the old economy may not come back, but we need to transition to a new green economy. We need to look at what kind of future we're going to be building.
So as was once said, never waste a good crisis.
Exactly.
If there's this feeling of change, of something significant being altered perhaps, then what is the opportunity for the Canadian economy in that moment?
Yes.
Okay, thank you. Thank you, Chair.
Okay, thank you, Mr. Cohen. We'll go to Mrs. Bateman, please.
Thank you very much, Mr. Chair, and thank you to all of our witnesses. I very much appreciate the discussion that we've had this morning, and it's very interesting because one of the witnesses, actually it was Ms. McEwen, referred to the fact that, and twice in her testimony referred to the devastating recession that we have come through. And, our government takes a great deal of pride in having performed better than any G7 country after that devastating recession, to use your words, and to have created $1.2 million net new jobs in that context. So I didn't realize, that we were kindred spirits until today. Anyway, I really do want to talk about the productivity issues that some of our witnesses have raised. And for example, Ms. Corbden, you're 235,000 people put bread on the table because of your industry. That's incredible. And you did speak about productivity. Could you take just a few minutes to expand on that?
Well, I think that it's
very interesting.
Yeah, I think that it's one of our reactions through the decade that has been, a sheer difficult time, was to focus in on retooling our operations to seek better productivity than any of our competitors globally. And so we have a full report, which I'll be happy to submit to the clerk on this. I don't want to maybe spew off a bunch of numbers for you, but there is a significant effort that has gone on by industry.
Feel free to spew.
Yeah, but really, we in our sawmilling sector, for example, we outpace our U.S. counterparts. In the overall Canadian sectors, we are the leader. I think the only leader beyond us would be agriculture. I've got my colleague here with me. So yeah, I know we really did have to double down and make some major changes. And continue to move on that productivity track.
Awesome.
We've adopted tons of innovation. I mean, I can go on about this for sure, but essentially the innovation that's come out of this innovation system I was referring to has helped us improve our productivity. And what I love is that we're adopting the innovation that we've jointly invested in.
Wonderful, wonderful. So it's not just the Forest Products Association of Canada that is experiencing better productivity. We've seen data recently indicating, and I'm quoting from some information we have here, that Canada's productivity levels are actually above the United States. So I'd like to ask Ms. McEwen, this is a fact, and we have Canadian productivity levels actually above the United States level. How do you label the current situation a crisis when it's not only is the Canadian economy diverse? I believe oil and gas is about 7.8% of the economy, but many economists and certainly many energy experts and many of the people who have given testimony in the last several days are saying that now is not the time for panic or overreaction. Your comments?
I don't think that anything I've suggested is that it is time for panic or overreaction.
Good.
I think there are things that we knew in October that we needed to do that would still make sense to do now and would help to take the edge off if something were to happen. I think that if there is a crisis, it will be because governments overreact and cut spending.
So you're recommending that there not be an overreaction?
Right. I think that the advice I gave before the price of oil still stands as good practice.
Okay, thank you. And that's very congruent with what our Minister of Finance has done. He doesn't want to overreact.
I disagreed with him before, though.
But there is congruence because he's taking time. Just as the wonderful mayor from Wood Buffalo, the fiscal prudence that they're demonstrating is taking time to make sure that they can assess, and that's in fact what we're doing with our federal budget. I'd like to move to Mr. Watkins, and if you, sir, could speak to the productivity issues of if you could speak to the productivity issues in your industry, and I would actually, as a Manitoban, a proud Manitoban, you were commenting about high energy prices. You really ought to move to Manitoba because our hydro's very affordable.
One of our members is there, actually. No, it's a very good question, and I guess I'd add just a couple points to I think what every industry's done, which is had to become more productive, more efficient in its operations. Certainly it's been a challenge for us. We're a heavily trade-exposed sector. We're competing not just with the U.S., but with Asian and European countries as well in our own market. So we have no option but to improve our productivity and compete. One of the interesting ways I think our industry has changed over time, I've been with the association now for 8 or 9 years, and our employment levels have gone down, but our production levels have not, so that's a productivity increase. But one of the things we've actually been able to learn from is their, in a sense, the transnational nature of our companies, and so they're adapting best practices from their global organizations, and I can tell you that some of our practices are being adopted by sister companies in other countries. So we're working hard at it. We've made a lot of improvement. There's always more needs to be done, and there's also a role for public policy in that domain, as you know. So it's very much a key issue for us always.
Okay.
Very good. Thank you so much.
Thank you, Ms. Bayman. Colleagues, I just want to update you, there's about 21 minutes to the vote. The clerk has arranged to have a bus for those members who do have to go vote. I am going to stay. I'm going to pair with Mr. Cullen, so if others want to pair, they can endeavor to do that. But if you do want to vote, there will be a bus provided to take you to the vote. And just before I go to Mr. Bryson, can I get approval for the budget for this study? Okay, so moved. All right. Thank you. All in favor? That's great. Thank you. Thank you. We'll go to Mr. Bryson, please, for your round.
This committee has no trouble approving budgets during these volatile times. Thank you very much to each of you for joining us today. I'd like to start with your worship, Mayor Blake. The Alberta housing prices, we heard Mr. Cullen refer to housing prices in your community earlier. What is the impact of the precipitous decline in oil prices on the housing market in Alberta in your community?
Sure. A couple quick perspectives. We have had significant difficulty in having enough land to keep pace with the growth that we've experienced. In recent times, last year basically, we were able to secure more land, and so we took that out of the equation. And what was happening in the housing market preceded the price drop in oil, but we were getting to a point of stabilization. Houses are still very expensive here. I think, if I can recall, still over $700,000. The marketplace is seeing more people putting houses on the market. It is taking longer to move those houses, but the prices have not had a significant decline at this point.
Is there a sense of concern over the level of leverage around houses and the potential that as these oil prices continue at least well into 2015, as according to the private sector economists, that this could create a significant drop in housing prices?
I think market influence would have more effect on that. So if we undergo significant layoffs in the community, we have more people that are forced to put product onto the marketplace, that's when you would start to see an impact directly correlated. At this point, we're not actually seeing that to any great extent at all.
Thank you. Mr. Watkins, we have a period now where slow growth and lower commodity prices, these things are being predicted now to at least go into the midterm in 2015 for certain. With bond yields at historic lows, interest rates, real interest rates actually being negative, and a slow growth economy and stagnant job growth, is this a good time to invest in the kind of public infrastructure that can create jobs and growth today, and also a more competitive economy to create more jobs and growth in the future?
Yeah. I mean, from the point of view of the affordability for governments, different, in a sense, different question, but to the point of the value and importance of infrastructure investment to our industry, it's a very important segment for producers of products like rebar and structural steels and so on. I mean, basically our end-use customers, automotives and energy are very much in kind of the same rough percentages, sort of 33% range, maybe 35%. And then construction would be the third market, next big market that we serve. So construction uses a lot of steel in a lot of different ways, and so it's an important market for us.
Ms. Copton, you mentioned the importance of the U.S. economy and the potential recovery, and of course market access to that economy is important. The softwood lumber agreement with the U.S. is up to expire in October of 2015. I think there may be some other events in October, I'm not certain. But with that, are you concerned about that softwood lumber agreement and the fact that the Americans have not indicated a positive interest in renewing it?
The softwood lumber agreement has been a terrific agreement for the Canadian forest industry. The prevailing view, of course, was hoping for renewal. I think we want to hang on to that view. I think it's important that the Department of Foreign Affairs and International Trade spend time on every scenario and be ready. We really must do whatever we can to assure trade flows to the U.S. are not encumbered, we hope for a successful outcome. I'm sure, I know DFATD's, watching this very closely, and I think we must be vigilant here.
DFAT was watching Keystone XL quite closely as well. It might be helpful if we have a personal relationship with the U.S. President and the Prime Minister of Canada. Mr. Volpe, it's great to have you join us today. Compared to previous downturns or drop in the oil industry and commensurate reduction in the Canadian dollar, there's been a difference in the competitive environment around the auto industry in terms of the importance of Mexico today compared to the past. And given that our dollar's basically kept track with the peso and has dropped relative to the yen, is it possible that policymakers are overestimating the positive impact of the lower dollar this time around for the industry?
I think that's possibly correct. The growth in the auto sector from the final assembly point of view in North America has been southward, U.S. Southeast, but mostly Mexico. And so if you want to service a customer in this business, as my members do, you have to usually go to that market. And 55 Canadian companies have established 110 production facilities in Mexico. And so they serve their customers from there. And there is, in those cases, no advantage to the Canadian versus U.S. currency exchange.
Thank you very much. Ms. McEwen, given the slow growth economy we're in and the Bank of Canada affirming, along with CIBC Economics, the quality of jobs today and the soft nature of unemployment and the reality of underemployment, should we be investing more and taking advantage of this opportunity to build the kinds of public and economic infrastructure we need to create jobs and growth today?
Just a brief response, please.
Yes.
Okay, thank you. Mr. Bryson, it's Mr. Cannon's round. There's 14 minutes to vote. He can only stay if you stay, so can you stay for his round? Or?
You've been told to return unless there's...
well, I'm paired with Nathan, and Renee Mullen is paired with Dave.
But our whip makes those decisions.
It's fine if you're leaving. Then he has to go then too. So.
Okay.
One quick question then for Mr. Volpe.
Okay. Mr. Cannon.
I know that. Congratulations, your first 6 months of the presidency. It's been a big curve and a very busy one for you. I used to be in the auto industry, and I know that it takes. The new manufacturers, they work with your OEM and in the aftermarkets, and like 3 to 4 years out planning for model years. So how does this, the price of today's oil affect your agreements for the long term, and what, from a government's perspective, how have our policies helped your members prepare for the drop in oil prices?
Planning for supply to an OEM usually starts 24 to 36 months out as you bid on a program. There's very sophisticated hedging programs, and OEMs have engaged in the practice of pricing in Canadian dollars to purchase. The fluctuation in oil and currency right now is probably a momentary capture, and for long-term planning, it's less significant factor. And the more significant factor is, have we retained or can we retain OEM assembler customers close enough to Canadian suppliers to be able to supply them from a logistic point of view? And this government has been active in that retention of those customers here.
Fantastic. Represent Kelowna Lake Country in the Okanagan, Tolko, and forest industry. And I appreciate, Ms. Cobden, your your work in the industry and your comments today. The fact that it's been on the trade agreement, 38 new trade agreements, and I know that it's been a big, especially the Asia market, for your clients and your members. I just wanted to know employment situation, where we're at right now. How does it look, and trending? Do you have sufficient, and you're going to see a shortage, or where are we at?
Yeah, we definitely will. So it's a bit of a different quilt across the country, but overall, for sure, everyone is looking and hiring again, which is very encouraging. We're aiming for 60,000 new jobs by 2020. We're, well on our way. We've had 8,000 in the last year or two. So we are hiring, and definitely we still today are hiring. So given the circumstances and all the questions, I think it's important to reiterate that. So it's a big focus for us for sure.
Thanks. A quick question for Mr. Watkins. We briefly chatted before the meeting coming from British Columbia. You mentioned that in your comments that the price of oil is not the silver bullet. It's going to can help lower some of the cost. But one of the issues coming from British Columbia in the housing industry is you mentioned the R word, the price of rebar. Is there any indication from whether it's the Manitoba supply or any of your members being able to provide more affordable supply of rebar to British Columbian housing industry?
Yeah, as you know, it's an issue before the tribunal even as we speak. There was a recent determination by the CITT to establish anti-dumping duties in relation to 3 other countries. Our industry is prepared to compete in that market on a fair market basis, on the basis of market economics. What we find we can't compete with is foreign governments and foreign dumping practices, and that's why the trade remedy system is important. So the BC market is served somewhat by our members, but it's served by imports from several other countries, including the United States. And as long as that trade takes place on kind of market-based principles, then we simply have to compete.
Okay, thank you. Thank you, Mr. Cannon. Mr. Cote, s'il vous plaît.
Mr. Cote, thank you, Mr. Chairman. Thank you to all our witnesses for being here today. Ms. McEwen, in your Mr. Meyer's presentation this morning, he indicated that the change in the Canadian economy was not necessarily such a huge opportunity for the manufacturing sector. And in one of the elements of his presentation, he said that in a general way, the fall in the price of oil indicates that something is not well within the international economy, and that it's a sign of uncertainty, and so that has an impact on investment. Do you share that view?
At the geopolitics right now that are going on in oil-producing countries like Russia, like the Middle East, the decision of OPEC to increase supply, absolutely, it looks as if the reason for the price of oil is because of political instability globally, and that is of grave concern. Also, in terms of trade and growth, it's Europe is unstable, the United States is uncertain and unstable in how they're going to be responding to that crisis. So I would agree with that certainly has to come into manufacturers' decision making.
Et pour continuer là-dessus, on a l'impression.
And to follow up on that, we have the impression that we've missed a window of opportunity to be in a better position in order to benefit from the conditions that we have at the moment. Investment hasn't been so great in the manufacturing sector in general. We find when we talk about exports, non-energy exports specifically, there is a commercial trade deficit that's huge. Some sectors are working well, but in general it's a huge problem. I had the opportunity of reading an open letter by the economist Joseph Stiglitz that he published in Project Syndicate, where he indicated that the austerity measures and the lowering of taxes on companies had really led to the weakening of the economy and had no effect on investment. And he was saying that, on the contrary, that higher taxes were not an obstacle to investments by companies, in as much as the majority of investments are financed through debt in those companies, and that the interests paid on that debt can be deducted from import taxes. And so I think that we've missed the train. And so what do you think about that?
Congress has been calling for the past 3 or 4 years, I think, to use taxes to raise more revenue, to make public sector investments in common goods, again, to shift to the economy of the future that we're going to be needing green infrastructure, increases in public transit that the mayors across Canada are calling for, increases in retrofits to make homes more energy efficient, and to train workers to do these types of jobs that we're going to need in the future, and to make sure that workers in industries that are shifting and that industries that are shifting have the support that they need to transition to a different kind of economy.
Il me reste...
I even have a lot of time left. Ms. Blake from Wood Buffalo, thank you very much for being with us here today through video conference. I don't want to establish any polemical discussion, but I would say that you're a former federal member of Parliament. Brian Jean talked about the huge development of the oil sands and was talking about problems related to infrastructure. You shared that view this morning. I think your attitude is a good one. It is positive, but the challenge is huge, whether we're talking about road infrastructure or infrastructure related to services for the population. You said what type of decisions need to be made relative to hospital services, for instance. Mr. Jean indicated quite clearly that the management of the oil sands was not something that fell under the federal level, but rather the provincial level. Are you in agreement with his view?
Very generally, I am. I think that this is a significant investment in natural resource development, and the fact that I've got some 40,000 people that come to our region from all parts of Canada makes me believe that there is some evidence that the Government of Canada, not only benefiting from it, should also contribute to some of these more collective projects. If I look at the airport, that's just a fine example of what would be a good investment for Canada.
Merci beaucoup. Monsieur Watkins.
Thank you very much. Mr. Watkins now. I'm from Beauport-Limoilou, the 5 urban areas around Quebec City, and in our beautiful city we are having important debates relating to infrastructure. There is a tram project that has been put on the ice for a period of time. As Ms. McEwen said, we have to foresee that we continue to support an infrastructure program that's sufficient in order to deal with the challenges that our municipalities are dealing with, and not to mention the transportation between urban centres. Of course, we're living through an austerity period, regardless of the level of government. But the project was brought to the fore, but would be less significant and would be less costly. But there are experts who are saying, well, no, rather it's the time to invest in infrastructure and establish infrastructure that are those projects must be much more efficient in transporting people and in terms of circulation or traffic. And so do you, in light of the impact that this might have on your sector, do you think that we should direct ourselves to more active support for infrastructure at different levels? We could talk about a rapid train, for instance.
realize time's tight. But very quickly to the question. As I mentioned earlier, infrastructure or construction broadly is a significant end-use demand for steel products. And so investments in physical infrastructure certainly are, pull steel demand, frankly. So that is very much an area of activity that's important to our industry. We've been, supportive of efforts by both federal and provincial governments to put in place long-term infrastructure plans and do everything we can to encourage the procuring agencies to give every consideration to Canadian suppliers.
Okay, thank you. Merci. We'll go to Mr. Van Kesteren, please.
Sure. Thank you all for being here as well, too. I think just in answer, or actually as a lead-on to Mr. Cote's question about his statement about austerity and the lowering of taxes as being a drag on the economy, I wonder if we could get an opposing view, or if there is an opposing view from the other three members. Do you feel that that's a bad idea to lower taxes and encourage governments to spend less money? I'll start with you, Mr. Watkins.
Look, I think this was discussed a bit in the previous panel as well, that having competitive tax rates and regimes in Canada versus our competitors is very important. I think it has benefited not simply our own industry, but we always look at the impact of tax measures on basically our customer base.
So I guess my question should be, what the federal government has done in lowering corporate taxes and lowering GST and all these other, has that been a positive thing for industry?
I think it's contributed to the growth in manufacturing, but we also look at some of the very specific measures, like the accelerated capital cost allowance, which Mr. Myers commented earlier on the impact that's had on capital investment by manufacturing.
So positive.
So it's not, in a sense, just the tax rate, but it's also these related incentive measures for investment.
Ms. Copland?
I'm going to echo the point. We need to be vigilant on looking at our hosting conditions. I think great steps have been taken. More steps can be taken. On the point about spending less, obviously we have a strong partnership with the forest industry in that and with government and our innovation system and that kind of thing. And I don't think we should be ill-informed about what other nations are doing with their industries. So we need to be careful and considerate, but we still do need to look at how we work together in joint investments to compete.
Yeah. You'd agree that the two are connected. I mean, if we lower taxes, we as a government, because we're taking in less, have to be more cognizant of what Mr. Volpe, what do you feel?
So in our narrow band of parts manufacturers that export but compete ostensibly in NAFTA with U.S. jurisdictions and Mexican jurisdictions, one of the key sales points we have for investment here is the combined federal, provincial, corporate tax rate, and it is amongst all the other dynamics that we fight against. That's a positive for us for new customer base.
Okay. I'm going to go to Ms. Cobden for a second. Great success story. And our chair, illustrious chair, Mr. Rajat, and I, we served in industry, and we went through those trying times. Those were difficult times. I remember we all struggled with what we should do. And one of the things I want, and I'm going to lead, this is going to be a segue to Mr. Watkins. One of the questions that was raised was, were there other jurisdictions that have done other things in forestry? And interestingly enough, Sweden had. They started to recognize that boreal forests they cover the whole planet. Mm-hmm. They're going to start producing the industry. Now, you've done some marvelous things. You've done innovative things. It's great to see. As again, it was very painful to watch some of these mills close that were inefficient, that couldn't survive. But you did some marvelous things. So I'm going to ask you both, is there something else that the forestry industry, and I'm going to ask the steel industry, because you're in the same position. Interestingly enough, while you had the opportunity, when you had the low dollar, or the high dollar, you didn't take that opportunity. So, and I'm not being critical, but what I'm saying is that when the investment was made, when you had the opportunity to make the investment, we failed to make those investments. So I'm just curious, is there something that the forestry industry is doing besides just doing a great job milling and such And are there some areas that you're exploring that we could be leaders in as Canadians?
Yeah.
And Mr. Watkins, I'm going to ask you the same question.
Yeah, no. So first of all, I got to say it's really nice to be able to talk about some successes after the decade we've had, and so that's fantastic. Absolutely, we're exploring. We've launched Vision 2020, and it was not lacking in ambition. $20 billion we want to add to our $57 billion current situation. And we want to do this by ensuring we extract as much value as we can in a sustainable way to make products to serve the world. And we are on that journey. We've had some great successes with that journey thus far. The Investing in Forest Industry Transformation Program, for example, the Pulp and Paper Green Transformation Program. But I hope, to your point about what Sweden, Finland, Brazil, Russia, what they're doing, they're going to capture. They're gearing up already to capture the new growth that's coming. So we have to continue what we've been doing.
ACCA is it?
Yep, ACCA, yep.
Those are all important. Right. Mr. Watkins?
Sure. I'll speak to both sort of direct and indirect ways in which this plays out. First of all, while you did not see brand new steel plants go up in Canada since then, there's been a lot of actually investment in the operations we have, and you frankly haven't seen much in the way of brand new steel plants in North America, largely because of the pressure from overcapacity in China and elsewhere. So there has been reinvestment, productivity improvement, process improvement, technology improvement, including environmental technologies over this period of time. Another factor came up in the earlier question about the impact of dumped products. So if we're subject to dumped imports from other countries, that's going to undermine the competitiveness, in a sense, the validity of investing in Canada. So having a strong trade remedy system is actually an important investment factor for our industry.
1 minute. Okay, thank you. The other thing I wanted to mention, too, was there's been a lot of talk, and I think we've done that to some degree, and maybe we haven't done enough of that, but there's been a lot of talk about green energy, and I've been to China, and I've seen their mills. They are impressive, to say the least, but they're filthy dirty, and they use filthy dirty coal, and they don't really care about that. And interestingly enough, they're the biggest advocates of us getting into the green energy business. Now, can you maybe just tell us a little bit about some of those challenges that you have with where we're going? As you know what I'm talking about.
Well, again, I'll just quickly start. They are challenges for us too. And I bet that some of the mills you saw in China they're newer ones, not some of the older ones, which are still operating. Look, we have a range of environmental requirements we have to meet, a lot of them at the provincial level. So we do that. We invest in the technologies, new capital investments to do that. Long term, as an industry, our industry is working globally to find new technologies to, in a sense, make steel in some fundamentally different ways to deal with some of the GHG questions. So there's continuous effort in our industry to do so, and we actually think that our steel, from a GHG point of view, it's better to get Canadian steel than a lot of these foreign products.
If I just clarify, I just want to make sure that when I talked about filthy dirty, I was talking about the air. I wasn't talking about the plants, because you're right, the plants you could eat off the forest.
Yeah, well, again, it depends on whether you've got environmental regulations, and secondly, whether you enforce them. And I can't sort of...
Thank you. Thank you, Mr. Van Kester. And Mr. Cullen, please.
That filthy, dirty coal, it's coming from us. We supply the vast majority of that anthracite coal that goes in. I want to turn to Mayor Blake again for a moment. I may have missed this, Your Worship. I had to step out for a phone call, but you in your presentation, I think you talked about taking a breath, and that was the 2008 collapse when things got off the front burner for a moment, because the pace of development up until that point had been, I guess, breathtaking, to continue the analogy, and trying to keep up. What is the infrastructure opportunity for communities like yours right now, and in the context of very low interest rates and the perhaps a lower pressure on the workforce supply in Canada that Ms. McEwen and others have pointed out? Is this an opportunity for the federal government to assume some responsibilities in working with communities like yours to invest for what comes next once this particular pause is over?
I certainly think it's a great viewpoint. When I mentioned earlier about the vastness of the projects that we've had, the lag time that we had in 08 actually helped us to catch up a little bit, but we're still behind the 8 ball. We've got any number of committed capital projects that have not actually even commenced in some cases. But when you look at the broader picture, where can a federal government actually get engaged? Another project that comes to mind is we've got currently one road, Highway 63. It has been an incredible focus because it was so incapable of managing the volumes that we've seen of traffic, and it's also the only road that will take you from outside the community right through to the oil sands plants, but it serves every neighborhood in the region. It also carries all those modules of steel that will come up that road as well as dangerous goods that go in and out of the community, and so one road for that purpose is a very concerning thing for me. When I look at this industry and I look at the opportunity, we're mindful that a bypass road would be very beneficial to industry, and it is a significant cost that the municipality itself could never do. We're working to engage industry, we're working to engage the province, but it's another chance where the Government of Canada might say, hey, this makes ultimate sense for us to be a participant in to pave the path to the future, and I think it leads to economic diversification opportunities beyond the life of the oil sands as well.
This is, as the deficits have been an issue for this government, has run successive ones nationally, is now, according to the finance minister, on track to balance. Yet we are running I'm just looking up the numbers here, across Canada, tens of billions of dollars of infrastructure deficit that are going on, with municipalities like yours unable to meet the challenges, and that groups like from Fort McMurray to the Toronto Board of Trade to Vancouver and Halifax and beyond recognize that infrastructure, particularly around congestion, and I look at Highway 63 and just even the danger factor that goes in for workers or those traveling south to Edmonton, that I wonder, with these circumstances, why the government wouldn't see this as the opportunity to build the next stage for Canada. I want to thank you for that. I want to turn to Ms. McEwen for a moment. There's a connection, and this goes to Ms. Cobden's testimony as well as Mr. Watkins, and it's an implicit connection between an increase in productivity and efficiency within many of our industries and a drop in labor participation. Is it an explicit connection? That I come from a forestry sector in northern British Columbia. We've seen mills almost within the same breath announce major investments, $10, $20, $30 million into a mill, and then within a couple of weeks the layoff announcement comes because the mill becomes more efficient. There's just fewer people required to turn out that same amount of volume, or even more in most cases, that we've seen. I want to get Ms. Cobden just for a second before I go to you, Ms. McEwen. How many people Canadians worked in the forestry industry, say, 15 years ago?
100,000 more, actually.
100,000.
And it's not from, I would suggest, though, that we have not seen, this is not all from productivity improvements that this changes. The vast majority of those jobs were because of structural and significant downturn in the economy.
Yet when we return back to a more robust U.S. housing market, for example, with those investments being made in a place like forestry, we're not expecting the uptick in, and we were asking this of the manufacturers. This is why we're doing this study, is to understand that if the U.S. picks up, if the dollar's lower, if interest rates are low, are we going to see manufacturing surge back? We've lost 400,000 manufacturing jobs across Canada since this government took over. No one seems to be presenting the case that we're going to get anywhere near replacing those good-paying middle-class jobs just because of some structural changes that have gone on in our economy. Is that a fair assessment?
I'd like to say that the position that I've tried to put on the table is that we do have a tremendous potential ahead of us, but it's not going to be easy, and we're not going to be able to get there, I think, alone. So we have 60,000 jobs. We think that's for like the next 6 years that we want to achieve. That isn't making up the full lost ground. You're absolutely right. But I'd also suggest that if we actually got busy on grabbing the opportunities that are out there that Sweden, Finland, Brazil, and all these other places are grabbing, we'd have a lot more jobs than that.
So first to Ms. McEwen, then back to you perhaps. Give us one policy initiative that we should be considering right now, given the circumstance we're in, specifically about manufacturing, the experience we've had over the last 6-7 years. We've lost near 500,000 manufacturing jobs. We have the circumstance of many are predicting an energy price about here and a Canadian dollar having returned to something normal. What specifically would you respond to Ms. Cobden's comment? Would the Canadian government proceed with as a policy to help restore some of those manufacturing jobs or invent or create the new ones?
Okay, so we're a partner with the Green Economy Network, and we
Okay.
have a paper that talks about 1 million climate jobs. And we propose a three-pronged approach, which is using public procurement to increase investment in transit. If we have local procurement, which we're losing the ability to do that under CETA at the provincial level, but if we have used public procurement to purchase, say, transit vehicles, that capital infrastructure that's built in Canada that would use the steel that we make here, that we have a retrofit, green retrofit of houses that could use forestry products that we make here in Canada. We could train workers to work in both of those fields.
Sorry, I run out a bit of time, but I'm trying to think of an example, and I'm wondering, it was the so-called NDP budget of 2005. Part of that budget was for green infrastructure, particularly transit in Toronto. It was used to create subways in Thunder Bay.
Exactly. That's a fantastic example that we use a lot, is that the sourcing of Toronto subways from Bombardier kept 500 jobs in Thunder Bay. Okay. And those are permanent, good, long-paying jobs. And then we also say investment in renewable energy would create 1 million jobs itself and lower our greenhouse gas emissions over the next 10 years.
Thank you. Thank you.
Okay. Yep, just very briefly, please.
Well, I just think we should think about the existing manufacturing base and how do we add in these green opportunities. FPAC has a strong position in support of these ideas, but you have $1 billion of assets in each of these communities in rural Canada, approximately, give or take. Why wouldn't you build off of that? So something that links innovation, environmental performance, and building off of your capital stock is the kind of idea that we would like to suggest is worthy of consideration.
Okay, thank you. Thank you, Mr. Cohen. Just a comment on that point is, I agree, and I think the ACCA is actually an excellent example. It not only helps companies in terms of productivity, it helps in terms of newer equipment, new machinery is more environmentally sound as well. So it accomplishes two goals in my view. Mayor Blake, I just wanted to clarify, I'm from Edmonton, I'm Albertan as well. Highway 63, just to clarify, Highway 63 is being twinned, but my understanding on Highway 63 is it was not a lack of federal funds or federal priority, and I don't want to blame another level of government, but the reality is the federal funds were ready to go quite some time ago. I think it was the province in terms of identifying its priorities. It's very high on the province's list, but it is being twinned now, and when will it be completed? And can you just clarify that the federal funds were available some time ago for that project?
Yes, I certainly can confirm that. My understanding, of course, is that the detriment in terms of applying those funds and making it happen is that there was no completion date for that highway until probably 2 years ago now, when they finally said that they would invest what they needed to complete that task by 2016. So I'm very optimistic that by the end of next year we should be able to have that fully opened. What we're experiencing is great improvement, and I do thank the federal government for their contribution.
Okay, I appreciate that clarification very much. I wanted to, Mr. Volpe, I wanted to get to your presentation. I thought it was very good, and one of the things that we're doing in these hearings is we're showing the complexity of the relationship between oil prices, the Canadian dollar, but also, we can't just simply say as policymakers, Canadian dollar goes down, benefits to manufacturers, it's all good. And you've explained that very well. I mean, one of your things you talk about, plant overhead is a mix of Canadian and foreign currency-based exposure. Canadian-based costs include electricity, indirect labor, and local services. However, virtually all specialized and heavy machinery and ancillary equipment are based in U.S. or Euro currency costs. So can you just speak to that in terms of identifying for the committee that companies in your sector and others may want to comment, it is a more complex picture than simply saying dollar goes down, benefits to manufacturers and exporters.
Sure. I think that there's a contrast that's got to be made in manufacturing. There's the primary industries and the secondary industries. And if you're deriving goods from primary industries in market and you're dealing in Canadian currency, it's one thing. On secondary industries, we're assembling subproducts and inputs from not just the U.S., but from European origins, Asian origins, South American. So there really is a complex matrix of what goes into the product. And our customers, in my business, we don't deal with a retail customer. We deal with a couple dozen final assemblers, and their footprints are all over the world, and they're certainly in 3 different countries in this continent, and so we're dealing in a whole bunch of different currencies, both for input and for output, and their plans are some of the most important people on their teams for us are their modelers, their futurists, and their program planners, and they don't worry about the price of oil in the short term.
So in terms of your suppliers, you're dealing with at least 3 currencies.
That's right.
And in terms of your customers, you're dealing with 3 currencies as well?
On a declining scale, I'd replace 3 with dozens. But in terms of important currencies, the North American ones are the ones we primarily deal in, and with the addition of the euro.
Okay. So overall, though, is the declining dollar a net benefit?
In as much as you're exposed to an American customer dealing in their currency, there's a momentary capture. But those customers also then turn around. What we talk about is customers. They'll look at what we sold them this year, and then ask for givebacks. And then when they price the next program, they like the lower dollar as much as you do. The problem is we buy our goods in U.S. dollars, so we've got to push back.
And do your members, I assume your members hedge then?
Yes. And they've learned to hedge over the years, but there were structural differences up until, I think, maybe 10 years ago we were dealing with a 62, 65 cent Canadian dollar and lots of Canadian final assembly production. And then the world fell apart, and everybody's understood that if you're going to survive, you've got to hedge. And that's not just hedging on currency, but also hedging on footprint. And there's lots of strong Canadian companies that supply their customers from U.S. plants and Mexican plants. So you've got all your other input costs like labor in that domestic currency.
Sorry, you not only hedge on currency, what was the...
We also hedge with your production geographically. So hedge on currency from your operation within Canada, both on buying and selling.
You hedge in terms of how much you allocate here, depending on...
Right.
Depending on currency or depending on a host of factors?
It's a host of factors. But if I wanted to serve a customer that assembles in Tennessee, I may decide to set up a plant in Tennessee and serve that customer there. As a Canadian company, but with a Tennessee footprint. And the same could be said for Coahuila. And that helps buffer the currency that our customers are already hedging just on a transactional basis.
Okay, that's fascinating. I appreciate that. I wanted to move next to Mr. Watkins. You talked, and this is something I believe very passionate in terms of we set up these false dichotomies between West and East manufacturing and energy. As you know, because you've been to Nisku in my area, you have a member there, Tenaris. You have other members in the area who very much are linked to the energy sector. And so when people say here's energy and here's manufacturing and they're 2 dichotomies they don't meet, you know very well that, in fact, they're integrated. In fact, the other panels have said manufacturing and energy are much more directly linked than they have been in the past. So I'd perhaps like you to speak and expand on that. I know that was in your closing, but if you want to expand on that point.
Thank you, Chair. And it's very important to understand that connection. And as I tried to explain earlier, I know you're talking about Tenaris in your own riding, but again, the products that they are supplying kind of through there originate with steel made somewhere else, right? So this supply chain effect across the country, we think, is very important to showing how manufacturing and energy are not just compatible with each other, are interdependent. And as I explained earlier, I mean, we would sort of trace those pipes in Nisku, if you want, or in the ground in Wood Buffalo, back. We can trace that back to an iron mine in Quebec as the start point. To a steel mill in Ontario or Quebec or Regina as a processing point, or Calgary and onward. So those connections, and it's not just kind of material moving. There's a value added at each one of those steps, right? So this is a value-added chain across the country when we get Canadian steel into the oil and gas segment, and that's why we're so keen on that development. We're equally supportive of the efforts to spur LNG investment in British Columbia. That's, again, a very steel-intense business. not just at the port, but back into the gas fields as well, and transporting the gas to port. So these are essential relationships. And what's really changed in our industry over the years is the proportionate importance of that, if I can call it, in terms of our production. So we grew up as an industry largely based on a lot of it based on automotive and construction, and the energy sector now, as I say, is kind of in the ballpark with automotive as an end use of our steel products. That's energy broadly defined, but it's a very important set of relationships. And the key point, I think, to your question is it doesn't all happen in Alberta. I mean, a lot of what's happening in Alberta is actually causing things to happen in provinces east of there as well.
Okay. Well, I appreciate that very much. Thank you all. This has been a fascinating panel. And Mr. Cohn?
If I may, just to Ms. Cobden, is it possible for your industry association to produce, you talked about the trade to China. Do you have a value ratio between value added and raw export to China? That's been a curiosity of mine. Is that something you can provide? Not necessarily now, but...
Yeah, absolutely. But just to say, it is, there is a very small component that is raw logs, for sure. I know that continues to be raised by this committee. But the value components are pulp, lumber, paper.
Great.
I mean, and so we'll get all that to you. Yeah,
Okay.
for sure.
If you can provide that to the clerk, we'll ensure all the members of the committee get it. And if there's anything further any one of you wish the committee to consider, please do provide that, and we'll ensure all the members get it. I know there are some other questions, but I think we'll have some conversations offline after the meeting. So thank you so much for being with us here and responding to our questions. Thank you.